acquiescent are saying high inflation solves high inflation. And let's remind ourselves in the chaos to Friday at 8:30 that there's people like Ed Hyman, David Rosenberg, and others that say service sector inflation will flatten and then we'll come in and disinflate with the goods and disinflation we're seeing right now.
They wish it was that simple, don't they?
They don't know the
central
x-axis.
banks.
They don't know the timeline.
They're also incredibly concerned about the psychology of higher inflation becoming entrenched.
Yes.
And that's something that they're worried about, and I imagine they believe the clock is ticking too, which speaks to this faster point, right? Get up, get to sufficiently restrictive as fast as you can, and I'd sit here and say, well, where is sufficient restrictive? Do they have any idea?
On radio, John, you don't see this, folks. We've got the 210s banner up on TV. John, a negative 107 beeps?
Yeah.
Like that was supposed to be like back to school this fall.
It's early 80s stuff. It's nuts. That's where we are.
Let's do this now, and we do it with someone steeped in economic history. When you're at the University of Bath, as John Farrow says it, and you need history, you go over and look at the Roman ruins. Sharon Bell has done that with Goldman Sachs European equity strategist this morning. How did Goldman Sachs off the London desk synthesize yesterday's festivities in Washington? Sharon, how did Goldman Sachs London adjust?
So I agree with your comments. I feel that the adjustment we've seen in markets has been quite small, given the news that we have from Powell that, their view would be that they need to tighten a bit further in a way in order to push those inflationary trends down and stop inflation becoming a bit more embedded. We've increased by 25 basis points our view on where the Fed terminal rate will be. We expect them to keep hiking all the way through to July. We're now looking for 5.5 to 5 3/4. So I've been a bit surprised at the lack of reaction, I guess you could say,
yes,
in risk assets like equities.
Yeah, I saw that yesterday, and the VIX really not moving right now, 19.59. It's got a 21-22 feel. We're not there. So within equities, Sharon, when you talk to Peter about how you bifurcate equities given what is going to come, is it profit-making and non-profit-making? What are the factors that matter in what to own in equities?
Yeah, it's tricky. We think equity returns from here will be quite low because you've got this kind of non-ideal environment. You've got rates going up and you don't have a lot of progress on earnings. So that combination is not brilliant generally for equity markets. And valuation, particularly of the US market, still looks quite expensive. So where do you go? Europe probably looks a little bit better than the US because you're seeing growth pick up in China with the reopening, and Europe has a lot of exposure to Asia and China. And also Europe has lower value stocks too, which suffer less in a higher rate environment. So I would be looking at more value ends of the market. Commodities have been a little bit left behind in all of this as well. I would have expected a stronger commodities market year to date. We think as global demand picks up later in the year, and particularly with China reopening, you'll see commodity prices rise again. So perhaps some stocks exposed to that, and then more value areas like financials.
Sharon, has the trade with respect to European equities already been played out, especially because we've already seen the reopening kind of enthusiasm around China, and we just got data kind of was throwing some cold water on this feeling that perhaps the Eurozone could avoid some sort of recession or stagflation with the Eurozone economy failing to grow in the fourth quarter?
Look, I don't think Europe is going to run away with fantastic growth. And I do agree with you, European markets have done well year to date. But I think there is a big difference between Europe and the US. And that is valuation. US companies trade on average, the S&P trades on about 18 times PE. Europe trades on 12 to 13 times PE. So there's this big gap between the two. I think that you're not pricing so much into European equities, even with the rally we've had year to date. The other thing to note is European earnings have been quite resilient. So the fourth quarter earnings season was quite good. Yes, the economy may not be all that strong, but the earnings of European companies have been reasonably resilient. So that resilience and low valuation makes us feel a little bit more positive. But I don't want to overemphasize this point. We have very low returns in Europe too for equities this year.
How vulnerable are some of the big corporations in Europe to a euro that could depreciate if the U.S. truly does surprise to the upside with respect to the pace and to the level of rate hikes?
Yeah, and look, I think it's a tricky one, isn't it? Because you could say euro depreciation is good for European companies. They're very, very global in their mix. Only 40% of their sales are domestic to Europe, 60% are outside. A lot of that is dollar earnings. So if the dollar is going up, you're making much more earnings when you translate that back into euros. So fantastic. But actually, generally, you're totally right. There's a positive correlation between European equities and the euro. The euro's going up, people are more risk on. They believe that growth is going to be better in Europe, and they tend to invest in European assets.
Sharon, there's a drinking game when I ask this question, so get your tang out right now. Sharon, it's real simple here. I see higher inflation. Maybe I see some GDP growth, maybe like what we see in Japan, which sums up to a more vibrant nominal GDP. Does that fold over to a missed revenue guess, where revenues do better than your modeling?
And that does seem to have been the case. Although I wouldn't just say revenues, margins have held up much better than we expected and than our models would have predicted last year. So we've been surprised on both counts that the top line has been a bit better than expected. I agree that's related to nominal growth, but companies have been able to pass on a lot of the additional costs that they've been seeing through to the consumers, whether that be businesses, other businesses, or households, consumers. So margins have been a bit more robust as well. And I think that's been a bit of a surprise to us in Europe particularly. So I think if it's back to this point about European earnings being a little bit more resilient, being very, very global in their nature, those things are good. But of course, what's unhelpful is rising interest rates.
Sharon, before I let you go, you talk about the exposure to Europe, to the reopening in China. And we talk about this as a positive for growth. And at the same time, here in the U.S., we talk all about this geopolitical risk. That's sort of a catch-all phrase that people use to talk about the increasingly fiery rhetoric between the U.S. and China. How do you express concern about some sort of regulatory pushback in companies in Europe that are very exposed to China that could get hit by some of this, or do you just basically shrug it off and say it won't happen?
Yeah, look, I think that there is a view generally that having a kind of wide international spread is not such a bad thing. You get, some economies are growing, some economies are weakening, and you've got a broad spread of exposure. But having just purely a China exposure pocket, that does leave you very open to geopolitical risk, to China, to supply chain risk, etc. So people are aware of that. I think most of the companies with exposure to China are very global in their mix, so they're not just solely focused on China.
Sharon, wonderful to hear from you. Again, Sharon Bell of Goldman. Sharon, thank you. Said this a few times to Sharon over the last few months, but I remember she joined the programme a number of months ago and said, get long European banks. And I pulled that face where, I'm like, what are you talking about? European banks.
I've never seen that. I've never seen that.
And that face, I pulled that face a few times over the years, and often the individual becomes right, and I have to take it back and say that face wasn't deserved. Yeah. Bank stocks in Europe are up more than 20% year to date. They have ripped off the lows of last summer. Yeah. It's been phenomenal to see.
I don't have a strong call on what they do from here, but let's be clear, on a ratio basis and with the ample dividend, they're priced still way below the American profit-making and dominant banks. I think we've got to talk about surveillance entertainment here. And I think on the commercial banks, we got to go big little like the sports programs.
What would you like to do?
I'd like to have the camera on us, or even have the ads in silence so they can hear us.
Would you like us to line up before the show and sing as well?
No, I don't want to do that. They don't need to see
my European bank face.
Before the Champions League.
I think I'm pulling out your European bank face to that suggestion.
When we sort of all shake hands before the game starts.
What are we talking about, really?
Well, Tom's thinking about doing sort of a sport-type broadcast.
Would we shake hands with each other?
Yeah.
Look,
producer.
What was the highlight yesterday?
Take a gargle of water, spit it out.
What was the highlight yesterday?
What of?
Anna Hahn making clear Team Mercedes is going to do better in Saudi Arabia.
Oh, she's a Lewis Hamilton fan.
Yeah, I mean, that's what the show's about.
It's like F1 overload at the moment on this program.
It is F1 overload.
Yeah. That side of the table.
Christian Horner.
Not on that side.
Christian Horner, Red Bull emailed me, said, Tom, enough.
Asselinos is coming up from RBC Capital Markets. Looking forward to catching up with her on foreign exchange. Big move in the US dollar yesterday. Dollar stronger, euro dollar back to 105. The bond market is just where the entertainment is. It depends where you are in equities, whether you find it entertaining or not, I guess. US. Close to 4% on a 10-year. We really didn't do much on a 10-year yield yesterday. The heavy lifting at the front end of the curve, the 2-year, through 5% for the first time since 2007. This morning, we add some more weight to it, up around about 3 basis points going into Chairman Powell Day 2. Yesterday in front of the Senate Banking Committee, a little bit later this morning, 10 a.m. Eastern Time, in front of the House Financial Services Committee. That's coming up a little bit later.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. In less than 5 weeks, Federal Reserve Chair Jerome Powell has changed his tune. On February 1st, Powell said the disinflationary process had begun. But on Tuesday, he told a Senate committee the ultimate level of interest rates is likely to be higher than anticipated. Powell said he's ready for faster monetary tightening if economic data justifies it. In the UK, Chancellor of the Exchequer Jeremy Hunt may give companies extra tax relief on investment spending. Hunt's looking for measures to boost economic growth in his spring budget. He's under pressure to act because Britain's flagship corporate tax break expires on April 1st. Ukraine says that a European Union proposal to buy $1.1 billion of ammunition isn't enough. The country's defense minister says Ukrainian forces need about 4 times as much. The EU's defense ministers have given their cautious backing to sending ammunition to Ukraine from existing stock. The White House has endorsed a bill in Congress that could give the president authority to ban or force a sale of TikTok. That could break a deadlock over how to address privacy concerns around the popular Chinese-owned app. Now, the bill doesn't mention TikTok, but the video-sharing app is the clear target. It has about 100 million users in the U.S. And Silvergate Capital is in talks with U.S. regulators on ways to salvage the troubled crypto-friendly bank. Bloomberg has learned one possible option FDIC officials are discussing includes lining up crypto industry investors to help Silvergate shore up its liquidity. Regulators arrived at the firm's La Jolla, California offices last week. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Seeds, typically between the time you start and they get out in the farmer's fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
I think the Goldilocks scenario that we see is the least probable of the outcomes, and it's really what the market's been pricing at the start of this year, the U.S. equity market. It's this idea that we do get this gradual fading of inflation, and the Fed are able to engineer this no landing or soft landing. We still get robust growth. We don't get a collapse in margins. We still expect to see a recession this year, Our economists have pushed that back 1 quarter from Q2 to Q3.
That was Greg Battle there, the US head of equity and derivative strategy over at BNP Paribas.
yesterday.
I think he felt good yesterday, didn't he?
Good day.
So Greg and the team are looking for 575 on rates. That's Carl Riccadona's call. We're just south of that in terms of what we're pricing for the peak rate in this rate hiking cycle.
So far.
And he's looking at 3,400 on the S&P 500 year end. I mean, we got closer yesterday, but we're still a while away, aren't we, on the S&P 500. To your point, Bramo, you said it a couple of times already this morning. I think a lot of people will sit here and say, you know what, that resonates with me. We saw a big move in the bond market, some real milestones that we haven't hit in decades, looking at that yield curve inversion, a 2-year through 5% for the first time since 07. And yet equity's down 1.6%. And I looked at high yield spreads at the close yesterday. Nothing. Dead flat. Totally unchanged.
You're not seeing that.
Why?
Basically, people, I honestly can't explain it. Honestly, if I gave you a real explanation, I'd be lying. There is a feeling that perhaps this economy is more resilient to higher rates. And if that's the case, then you could see rates go higher without a commensurate downturn in the economy. And actually, HSBC pointing this out, if you take a look at 10-year yields south of 4%, that's indicating a soft landing. That's indicating that rates will remain higher, that we're not going to crash in some sort of phenomenal way. And they're looking for those yields to go down because they think that's perhaps too optimistic.
John, a break. You said something really, really important. In all this turmoil,
I said a lot of things. Don't share some of it, though.
Oh, God. There's a fly over here on the wall.
Be selective here, TK.
I'm going to be selective here and say
diplomatic.
John nailed it. And what you need to know this morning, folks, in this true turmoil as we go to the chairman's further comments today, we further steepened this morning. I think that's not in the zeitgeist this morning as we've moved forward from the shock of yesterday to further inversion.
Yeah, another 3 basis points on a 2-year. I know, this curve is inverted by another 3 basis points. Deeper inversion, Tom, 107.
Yeah.
2's 10's 107, look at that. Do you remember when Priya Misra came on the show from TD a number of months ago and said, -50? We were like, wow, -50. -50 sounds crazy. Where's the equity market going to be? And here we are at -107 basis points on a 2-year versus the 10-year.
Shout out to Ira Jersey, who also extended out from something that was measured 60, 70 beeps out to 80, 90, and now 100 basis points on the difference between the 2 and the 10-year. It is a perfect time to talk to Elsa Lingos, yes, global head of FX strategy at RBC, but far more schooled on the interdependencies, the dynamics of our major central banks. Elsa, an open question as you try to figure out what to write about this weekend. How linked are the central banks right now?
Oh, it's a great question, Tom, because actually that's one thing that really stands out about some of the moves year to date. In relative terms, we haven't actually seen particularly big moves. A lot of this is happening in sync. So you have the Fed being repriced, you have the ECB being repriced, you even have the Bank of Japan being repriced. It does make for a very interesting market where most of the cues for FX are coming from asset class interplays rather than relative movements.
Does the dollar move up? Higher U.S. interest rates, I need to own dollars. Can we see a foreign flood into a strong dollar trade?
So we've got a framework we've been using for more than a year now that we find really helpful in predicting asset class and currency movements. And it's really thinking about that interplay between bonds and equities. So when we see bonds and equities selling off together, as we did for a lot of last year, as we did in February, we tend to see a very strong dollar environment. Equally, bonds and equities rallying together. The tail end of 2022, start of this year, is weakness for the US dollar. And when you're in this kind of no man's land, you end up just going for more of those relative value trades in FX, which is where we are at the moment.
I fear for the Bank of Canada today, Elsa. It's actually probably one of the more interesting aspects of today amid a slew of news items, because if Bank of Canada does come out and do as expected and pause their rate hiking cycle, this could potentially be really negative for their currency. How closely are you watching this in terms of understanding the pressure that the Fed is putting on other central banks right now?
It's a great question, Lisa, because I think a lot of people expect the Bank of Canada to have to follow the Fed almost slavishly, given the very strong economic ties between the US and Canada. And yet sometimes the US actually does the work for the Canadians. And so they almost have to do a little bit less at the margin. And yes, the currency may take a hit as a result. But the forward curve to a large degree has been priced for that pause from the bank. We only really have one more hike in the forward curve at the moment. So I don't think it should be too big a shock to currency markets if the Bank of Canada does stick to that conditional pause for now.
If that's the case, then on the margins, do you just see more dollar strength going forward than perhaps people have been expecting, not just versus the Canadian loonie, but also with respect to to what we see with the euro, with what we see in particular over in Asia, where a lot of the reopening trade has already been priced in?
Yeah, so, we did start the year when bearishness on the dollar was very popular. We did start the year perhaps a little bit more cautious. We were looking for some dollar weakness in Q1, probably not quite as much as we saw. And yet, as the year plays out, it's hard to really get carried away by the bearish dollar trend. That's not to say we're massive dollar bulls. It's just I don't think 2023 is going to be the mirror image of 2022. Whereas last year was all about strong dollars, this year for me is not all about weak, really much nuanced than that. And to really make a decision on that, I think you have to get into the individual currencies. We still like dollar yen higher. We still like a lot of CAD crosses rather than just outright long or short dollars.
Given this sort of no man's land, this chop that you're talking about with the dollar, and also the idea of an economy that likely will deteriorate near the end of the year, how concerned are you about the developing world, especially given the scarcity of dollars and some of the concerns that have been coming to light over the past few months?
Yeah, it's an interesting moment, right? Because we had the announcement over the weekend from Chinese authorities setting a growth target that was definitely at the low end of people's expectations, around 5%. Certainly no payback for the weakness in growth we saw last year. Trade data earlier this week from China, again, not seeing signs of that big import boom that some were expecting. It's still early days, but it doesn't look like a picture where the rest of the world is going to be booming in growth, and it's just the US slowing down in isolation.
Alistair, a number of months ago, I was in London and asked a very simple question to a lot of guests. I said, who's going to hike more this year, the ECB or the Fed? The consensus was overwhelming. Pretty much everyone said the ECB. Alistair, where are you on that question now?
It's a great question, isn't it? I mean, don't get me wrong, the ECB still have a lot of work to do as well. But I know you and I have discussed this before on the show, John. The fact is that the US was cyclically stronger heading into the pandemic. It delivered more in terms of stimulus, both fiscal and monetary, and it's cyclically stronger coming out of the pandemic. Yes, it has tightened a lot more than the ECB, but there's a good reason for that. The ECB was not in the same position as the Fed at the start of this year.
Asalinios of RBC, kind of skirting that question just a little bit there, Tom. I mean, I don't blame her. I really don't blame her.
Slide,
yeah, I don't blame her. I wasn't going to push back too hard.
Well-schooled in Brussels.
It's really difficult to answer right now. If Holtzman of the Austrian Central Bank has his way, they're going another 200 basis points at the ECB. I'm not sure that's where the consensus is. But the idea we get close to 6 at the Federal Reserve felt kind of crazy a couple of months ago. It doesn't feel as crazy anymore. I'm not saying it's a base case for people, but certainly the probability around that view has shifted.
Ibrahim Rabari, Citigroup, the level of data dependency is off the chart. We have never seen it because, we're making a joke about it all this morning, but on a theory basis, this is uncharted territory. There is no theory right now. Let's just wait for the data.
You know what we're not talking about today? Long and variable lags. Nobody's talking about long and variable lags.
Yeah, that happened yesterday afternoon.
No, but this is actually important, right? Because there is a feeling of a lack of patience, right? There hasn't been the progress made. You are seeing revisions to the upside, not what this Federal Reserve wants to see. That patience is off the table. So all of a sudden, you have to start wondering, okay, well then is the balance of risks going too far at that point? Because they're not considering that at this point.
He touched on it briefly yesterday in the testimony. I think to your point, it's worth considering that 12 months ago, I don't think we've even had the anniversary of the first rate hike yet, have we? I think it's 12 months ago we were still at 0 and we were still doing QE. It's only 12 months later. I think the shift has happened because people thought we'd price in higher rates and the pass-through to the real economy would be faster than it's turned out. And certainly in the rate-sensitive parts of this economy, you can see it. It's just not spreading through in quite the same way.
And it's not consistent. I mean, yesterday we saw a big pop in used car prices. In some measures, the biggest pop going back to 2009 on a month-over-month basis. This is sort of a reinflation of some of the goods sectors that previously had been the source of the disinflationary process. This is confusing. So how do you come up with some sort of sense of whether we're making progress on diminishing inflation?
Yeah, I'm with Tom as well, though. This can all change Friday morning.
Totally
Where are we going to be on March 14th, which is when CPI comes out, at 8:31 Eastern Time? Just a minute after that print.
You think that's more important than jobs?
I think inflation right now is more important than jobs because they have no idea what the revision's going to be to that shock 500,000 number.
Yeah.
I have no idea what the revisions are going to be.
Can you imagine how the story changes? You get a big revision to January data, and everyone's like, oh.
Pause.
Okay.
My answer is I'm going to listen to Michael McKee.
Futures up a 10th on the S&P. Coming up, Sarah Hunt of Alpine Saxon Woods.
a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as started out a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far. But if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
From New York City,
from London, in Sydney, from Washington, in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Moment news breaks. No one covers the world like Bloomberg.
6 people have died from these latest quakes, adding to the 41,000 plus people who've died in those major quakes 2 weeks ago.
A top Sam Bankman-Fried associate said to be nearing a plea deal.
How does that help build the case for the prosecutors against Sam Bankman-Fried?
Biden is here to say we will stay with Ukraine until the very end, and that's really a show of support as well for the allies.
Bloomberg, your global business authority.
Our leading indicators continue to signal recession. Indeed, they say that recession should be happening right about now.
This is clearly an economy that's proving to be more resilient than a lot of people expected.
I think people came into this year feeling as if the recession was inevitable, and that no longer is the case.
We see the market getting down to 3,400, but then potentially flatlining through the second half of the year.
We do think that equities can drop lower, but for us, it would take a lot to see those October lows again.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Hello, 5%. Allow me to introduce you to 6. Live from New York City this morning. Good morning, good morning. For our audience worldwide on TV and radio, this is Bloomberg Surveillance. Equity futures up by 1/10%. Your 2-year yield through 5% for the first time since 2007. And Tom, some people out there thinking out loud, maybe this Fed has to go to 6.
Oh, that's out there, and it was an adjustment yesterday. I don't know, John, what was it, 10:04 a.m., 10:03 a.m.? Who's counting here? And as we said earlier, the adjustment continues this morning is the headline. But how does the equity market adjust? I think that's a major mystery we'll discuss in this hour.
We will talk about the resiliency of the equity market in the face of this 100 basis point move at the front end of the yield curve. In a single month, this has happened really quickly. It's Chair Powell, day 2.
I don't want to get Chairman Powell, day 2. First of all, does he walk it back? I have no idea. But what's interesting me, to borrow from the great mathematician Cliff Asness of the hedge fund world and AQR, you see the divide between bond volatility and equity volatility. There's some noise there. I don't want to go into it. I haven't had the third cup of Tang. You know what? It's massive the way bonds are looking at this versus the way equities are looking.
I'm going to say it all week going into Friday morning and on to March 14th. Everything we talk about is so highly dependent, Lisa, on payrolls on Friday and then CPI next week.
Highly dependent in the rate market, the stock market, and the credit market. I have no clue. Because just to build on what you guys are talking about, The NASDAQ outperformed yesterday. The NASDAQ did better than the S&P, the tech-heavy index that typically was the most sensitive to rates. What do you take away from this? I can't explain it. I honestly, you pick your narrative. Maybe people are saying job cuts are right-sizing these companies, that people have already priced in higher rates.
Yep.
I don't know. I can believe whatever narrative people want to sell me because honestly, I don't really understand
Well, let's
this.
see if that narrative stands up to the next 5 minutes.
Exactly. That's a fair point, too.
All over the place. Let's whip through it for you. Equity futures still just about positive by 1/10% on the S&P. The Fed chair spoke yesterday. He'll speak again this morning. Lisa will give you the time of that in just a moment. Just want to sit on the bond market just for a second. We've got a 10-year at 397. Yield's not doing much there. Yield's doing something at the front end. Your 2-year up another 3 basis points, 5.04%. The difference between a 2-year and a 10-year is now negative 107 basis points. Tom, we have not seen this since 1981.
Let's not bury it in the math right now, but folks, the pros look at other spreads than the difference between the 2-year and the 10-year. And John, they're even more dramatic, more historic.
Lisa, big moves in the last 24 hours.
Let's see if they're repeated today. Day 2 of Fed Chair Jay Powell on Capitol Hill testifying to the House Financial Services Committee. Do we get a sense of doubling down? My suspicion is probably, since, as John pointed out, it was in his written statement. Tom Barkin of the Richmond Fed is going to be speaking here in about an hour. Today, we also get a Bank of Canada decision, and I actually think this is going to be interesting at 10 a.m. They're moving in the opposite direction of the Federal Reserve. They're expected to pause their rate hikes. So do you see the carnage in the Canadian dollar? Do you see some sort of read-through in terms of the widening divergence? And today, in terms of data dependency, again, which data matters most? I'm guessing ADP employment data, 8:15, not among them, but I do think that U.S.
You're doing that just for me.
Well, I mean, look, people are going to take whatever tea leaf. We talk about this every time we get ADP. People come out and they say, it doesn't matter, it's not relevant, and then people trade off it. And we get U.S. JOLTS job openings data at 10 a.m., which also people would say is noisy, is backward looking. It's for the month of January. Does it really matter? It's messy. People post jobs that they don't actually fill. And yet when it goes up, everyone freaks out, and all of a sudden we're talking 6.5%
Professor
rates.
McKee has lectured me that JOLTS has value. Let's leave it.
Oh, well, Jay Powell has lectured us that JOLTS has value.
Well, Powell got it from McKee.
It's always noisy if it doesn't speak to you in the way you'd like it to speak to you. Right? Everyone's like, you know, the data worked last year, then this year they're like, yeah, can we just talk about the survey response to the economic data?
Exactly.
We think we've got a problem there. Okay. Sarah Hunt, Chief Market Strategist at Alpine Saxon Woods, joins us now.
Medicated.
Sarah, wonderful to have you with us this morning. Thanks for being with us. I'm sure it was a long day yesterday working through some of this. Lisa's made the point repeatedly this morning. We can sit here and look at that move of 1.6% on the S&P and make a big hoo-ha about it. Do you think that's somewhat resilient in the face of what we're seeing develop in the bond market?
I think it's very resilient. I mean, you look at what's gone on in the last, you just look at where rates are, and the equity markets are sort of like, okay, we're fine. We touched the resistance. We touched support. We're good. And I have to look at that and go, if we're really going to be higher for longer, and how high we get is also right now up in the air. But if we're going to stay there for not a period of months, but a period of years, which somebody mentioned earlier this morning, I don't think the markets are pricing that in. I mean, earlier this year, they were pricing in cuts by September, right? So I think this is part of the reason why you're not seeing the reaction in things like housing prices. Because if the expectation is rates are going to come right back down again, then I don't need to adjust my sales price because of higher mortgage rates. I think that we haven't really baked in that rates might be much higher than we've expected for a long period of time because we just had 10 years of zero rates. It's very hard for people to wrap their heads around.
Okay, so let's talk about the balance of risks. Is it more likely that rates markets are histrionic and going bonkers and are totally wrong, or that stocks just are not waking up to the reality that we're not going back to 2018?
B. Okay. I think that the rates markets bonds tend to not be as histrionic as equity markets, relatively speaking. And I think that there is just a lack of appreciation for how much higher rates are going to make a difference over a longer period of time. I think you're already seeing it. The last 2 months you saw credit expansion by people is going down, right? So what does that mean? People are buying less cars and non-revolving credit. I think that people are starting to change their behavior, but I think that does take some time. And this is that whole argument about what are the lags and what happens here. But we've only had higher rates for barely a year. So I think it's really, for people to change their behavior takes some time.
So what's the clarifying moment where all of a sudden we get a narrative and people say, oh my God, the sky is falling?
I don't know that we get a sky is falling narrative so much as we get a, you're not going to go back to the free money that you were getting, so just get over waiting for that to happen again, right? Like that is I think it's more about that and learning to live with higher rates. There are a lot of arguments about how much, whether or not governments can afford higher rates, what's going on with all the balances on everyone's balance sheet. But I think that in the end, if you get a rate structure that's above the zero that we just lived with for the last decade, there's more of an ability for people to use fixed income in their portfolios, which they hadn't been able to really use before. And there's just a difference in how people are borrowing money and whether companies can just, money is not free anymore.
You write about the soothing narratives that are out there for the equity market. We've covered Meta Facebook was the stock du jour yesterday on boardrooms dealing with the soothing narrative. How are corporations and boardrooms going to adjust to the soothing reality that we have?
Well, you've made an interesting point over and over again, which is that corporations adjust, right? So this is also where earnings might not fall off.
We're up to 42 viewers, folks, on radio and TV combined.
Sarah, just to be clear,
42
Yeah, I was about to say.
That's
what I was thinking. Okay, they adapt too. So they will figure that out. I don't think the corporate balance sheets are in terrible shape.
Celebratory tang.
I think you have some corporate balance sheets that are in bad shape, but for the most part, corporate balance sheets are in pretty good shape, and they have other ways of raising money. At equity valuations here, I can also raise equity, right? So they're not the problem. I think the problem is people who are not used to paying higher interest rates on their credit card balances, on their mortgages, on everything else, and that consumer is going to be more stressed, I think, than they are right now.
You nailed the secret. I come in, I get in way before Lisa. I got in before Lisa today,
and
which
he
is
waited
amazing.
for me at my seat to shame me.
I got out of the Bentley and I said, please wait, Abramowitz is coming
It was
to
a
the
long
building.
story. It was an Uber problem.
Sarah, this is really important. I went in yesterday morning early and looked at the capital structure of Apple Computer, small startup stock. They're grossly underdebted. To me, the surprise is with high coupons, corporations go out and begin to debt up here just to get back to some semblance of normal before 2006. Could we see a lot of corporate issuance here, even with these high coupons?
I think you've started to see it. I know that earlier this morning somebody was talking about how much money corporations were raising, but to the extent that corporations might believe that the Fed will stay higher longer, and that if they don't raise money now, they may have to pay more for it later, or if the curve uninverts, or we get any kind
of curve uninverts,
then you have a bigger issue about raising money.
Okay, you've got to pick names, got to pick some stocks. What do you like right now?
So I know this is going to sound tired, but I still like energy. I think that there's some fluctuations there, but I think, you look at something like a Devon with a 9% yield because they're paying a variable dividend. You look at something like Cheniere. We like the LNG story. We think that there is a longer term. You've got a change in what's going on in Europe, right? That Nord Stream pipeline isn't coming back, so you're going to have more LNG globally. So I think that that infrastructure play has some interesting things that are going on there, and there's some ways to play that in the stock market. We also think defense, even though it's expensive here, expensive at 18 times, defense, are we really getting any safer? Is the world getting any less problematic, and are we spending less money on defense?
Is Boeing a defense stock?
I think Boeing is more tied to the commercial market right now than it is to the defense markets. I think that the perception of Boeing is much more tied to their commercial business than it is to the defense business. So I don't think it acts as much like a defense stock as some of the straight up defense stocks. But you're seeing more money spent on defense, and we just went through a whole bunch of munitions in Ukraine and Europe. So I think that is something where you have some surety of income coming in, and I think that's going to be the big question. Where can I look for reliable, where I can see the sales coming in, I know that it's not going to be a big change.
Just to finish on energy, do you need the underlying commodity to participate, or do these levels work?
I think these levels work, but the problem is when it fluctuates, right? So natural gas came down from 8, which was very high, to 2 and change, which is very low. But that's where I think you're getting an opportunity on some of the energy stocks, because you do have these big fluctuations in the underlying commodity. And if you can pick them up when you have those downtrends, then I think you longer term, if you can sit with that volatility, I think you still have a pretty good long-term story.
Sarah, final question. Does the Fed end the year closer to 5 or 6?
Oof, I think we're going to have to say, that's a tough. Is it going to be higher than 5.5? I think we sit kind of right there. I don't really know, because I think that this is also where, are we going to jump to 50? I don't know. I think 25s make more sense. I think the market would be too shocked by that, but I think that's part of what you saw yesterday.
Sarah Hunt, thank you. Of Alpine Saxon Woods. What a change we've seen. Thanks for being in New York too. What a change we've seen in the last few months.
I want to pick up on what Sarah just said. It would shock the market to go 50. Will it? I think that right now, I wonder if the market's baking that in. If they're basically saying, okay, you basically said 50.
It upends a lot. It upends a lot. What's the trajectory look like from there? They go 50. What's the next one like? They have to go 50 again. They drop down. and then risk flip-flopping again. It's a real credibility issue attached to this. You know, they like to say we're not in the business of forward guidance. We want to go month by month. They're in the business of forward guidance. They like to keep that glide path smooth. They wanted to step down and stay there. They don't want to step back up.
How do you have a smooth glide path if the data isn't smooth, if this economy isn't smooth, if the recovery isn't smooth?
Risk management. Risk management. What do you think the bigger risk is? They started to embrace the disinflationary story early.
I tell my kids, you know, sometimes I just have to embrace chaos, and I wonder at what point they just embrace chaos.
Tell me about these Uber problems.
Let's just move on.
All right.
She's talking monetary policy to her kids. I'm talking pitch perfect. That's the difference in the house.
Equity futures up a 10th from New York. This is Bloomberg.
Keeping you up to date with the news from around the world. With the first word, I'm Lisa Mateo. Bond traders have boosted bets that the Federal Reserve will speed up the pace of interest rate increases. That's after Fed Chair Jerome Powell testified before a Senate committee. Powell told lawmakers he's ready for faster monetary tightening if economic data justifies it. Interest rate swaps indicate traders see a half-point hike is much more likely this month. President Biden's new spending plan will include what officials call one of the nation's biggest peacetime defense budgets ever. The total will exceed $835 billion. It includes big increases for weapons buying and research and development. In the former Soviet Republic of Georgia, riot police used tear gas and water cannons to disperse protesters unhappy over a so-called foreign agents bill. The measure would curb the influence of groups that rely on funding from the U.S. and Europe. Critics fear Georgia is sliding away from the EU and NATO and increasingly pro-Russian. Bloomberg's learned that Boeing is close to a deal to sell at least 20 of its 737 MAX planes to Japan Airlines. Talks are ongoing and a final decision has not been made. A Boeing win would be a setback for Airbus and its A320 NeoJet. The German sports shoe maker Adidas has slashed its dividend and shaken up management. New CEO Bjorn Gulden is personally replacing the head of global brands. Meanwhile, Gulden is floating the idea of selling the $1.3 billion of Yeezy gear and donating the profit to charity. Adidas halted sales after cutting ties with a rapper known as Ye. Global news powered by more than 2,700 journalists. I'm Lisa Mateo. This is Bloomberg.
Our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, starting Monday, March 13th, only on Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Today, Fed Chair Jay Powell testifies before the House Financial Services Committee. Tune in at 10 a.m. for live coverage. Bloomberg, your global business authority.
Fed's goal is to slow inflation. If you hit your projections, do you know how many people who are currently working, going about their lives, will lose their jobs.
Inflation is extremely high, and it's hurting the working people of this country badly. All of them, not just 2 million of them, but all of them are suffering under high inflation.
And putting 2 million people out of work is just part of the cost, and they just have to bear it.
Will working people be better off if we just walk away from our jobs and inflation remains 5-6%?
Just a brilliant exchange there with Senator Elizabeth Warren and Fed Chair Jay Powell. And Senator Warren doing a fantastic job of making this Federal Reserve wear their own forecasts. They hate the dot plot. I imagine they hate the projection materials they put out now, because these are the questions they're going to face. Unemployment's in and around 3.5% over the last couple of months, and they're forecasting a move to 4.6% by the end of this year, Tom.
To me, John, I'm going to go, I mean, it's off from what we do, markets and all that, but to me, it's just East Coast, it's ancient, 19th century, pre-1907, urban cities versus agricultural America. Now we call it Wall Street, Main Street, whatever you want to call it. That's really what this debate is about, and that's what Warren's out front on.
She's asking the right questions. What's the price we've got to pay to get inflation back to target? And the price she believes we have to pay is much higher unemployment and ultimately maybe even a recession. And I mentioned this in the last hour. There is a sense from some senators, and you can feel it, that they feel like this Federal Reserve is being intellectually dishonest. Just the idea being, can you really get unemployment from 3.5 close to 5 without causing a recession? Without a recession.
She asked, she said, there have been 12 times in the past, in recent history, where we've seen unemployment rise by a percentage point in a year. How many times did that avoid recession? You know, he said, well, you know, it's this, which, you know, 0, right? And so this is the question. Have they priced that in, and what does that recession look like, given what the Fed might have to do?
Here's the heart of the debate. I'm in the lunchroom at Carnegie Mellon, students all around, all that, with Alan Meltzer and Marvin Goodfriend. We're chowing down mediocre Carnegie Mellon food and a Yingling beer. And the answer is, Alan Meltzer took my head off because I told him you can't aggregate the economy. And he said back to 1947, that's the only thing we have, Tom, is to aggregate the entire economy. And that's what Powell's saying, aggregate. And Warren's saying, wait a minute, you're going to leave half the nation behind? That's really what we're talking about.
It's an easy line of attack for a politician anyway in a hearing like this, because if she's right, fantastic, she looks really good, and you get to beat up the Federal Reserve. And if she's wrong and Chairman Powell's right, doesn't really matter, does it? It's good for the Democratic Party, they're in control. The president's in the White House, won't make much of a difference.
What are we going to hear
if we
from
won't bring it
Patrick
up again.
Henry today? What are we going to hear from the gentleman from the Carolinas today? He doesn't have the depth of education that you have from Sherrod Brown or Warren, but he represents a huge voice in America.
This is the reason why these hearings are a little difficult for me. There are no easy answers. This is a tough situation, and everybody agrees that inflation is way too high. It has to come down to have a stable economy and stable employment. Question is how, right? And what Chair Powell said was the risks are not balanced, and right now inflation is still the preeminent risk. You can make the argument that's not the case, but I don't think many people are.
The best speech Chairman Powell's done in the last 18 months was Jackson Hole, Wyoming. It stood the test of time. It stood the test of time. If you go back and read the speech, that speech has stood the test of time. The problem is he backed away from it. And not just once, not twice, 3 or 4 times. And I'd throw this in there as well. It's not the first time we've heard him since that January payrolls report. He also did the interview with Mr. Rubenstein down at the Economic Club of Washington and didn't back away from it then either. And this has been the problem with this Fed chair in the last month. I have a ton of sympathy with them.
Yeah.
I think that we've all been surprised by how this economy is much, much less rate sensitive than we thought it was. But at the same time, the moment they had a sniff of the disinflationary process beginning, they embraced it and stepped down to 25. And the risk was always, and people flagged it, and I go back to what Mohamed El-Erian said around the decision going into it. This wasn't hindsight. Going into that Fed decision, Mohamed turned around and said, let's go 50, because if you drop down to 25 prematurely, you run the risk of flip-flopping, and flip-flopping will cause more pain than is necessary. And this is where we are.
Let's go to Amory Horton right now in Washington. She keeps score for us here. Amory Horton, to me, it is the greatest shift in modern politics to go from Maxine Waters, just north of Watts in Los Angeles, to Mr. McHenry of North Carolina. What an abrupt shift on the House Financial Services Committee. Who is Patrick McHenry, and why should Global Wall Street listen to him this morning?
Well, he's a key ally of the Speaker McCarthy, of course, and he's an individual that I think our audience really knows about. He's been in the financial world, outspoken about these issues in Congress. And we'll see what he has to say today when it comes to the Fed chair, Jay Powell. But what you're going to hear today from lawmakers is likely similar to what we heard yesterday. There's going to be the issue on capital requirements on banks, climate change, who's going to be his number two. And then the most important issues, of course, is where the Fed chair sees inflation and higher rates. And Tom, something you brought up about big cities versus rural areas, we should note it wasn't just Senator Elizabeth Warren talking to him about this concern of people losing their jobs. The quote from Senator John Kennedy of Louisiana, Republican, was, "You're trying to raise the unemployment rate, are you not?" That is what he said to Jerome Powell, because obviously if people lose their jobs, this is a concern for every single lawmaker.
I look, Anne-Marie, at the festivities this morning, and I just want to know what the Republican response is. Clearly, the Democrats driving the show yesterday got the visibility. Do the Republicans focus on boring surveillance economics, or do they take a different tact?
The Republicans are going to focus on issues that they want to highlight in terms of how their economic agenda is better than, say, the Democrats. So when you have the Democrats really wanting to get Jay Powell to talk about raising the debt ceiling in a very clean way, the Republicans are going to want to point to things like what they deem as excessive spending from this administration and how that potentially was a cause or added to the cause of inflation. So you will see these partisan issues. Also, Mike McKee and I spoke after the hearing yesterday and the testimony yesterday, and we were both quite shocked at how many Republicans came out and talked about the Fed Governor Barr's recalibration right now, looking at bank capital requirements. Almost the majority of Republicans touched on this yesterday. So clearly there are a lot of bank lobbyists that want Republicans to focus on this capital requirement. But really from the politics point, the Republicans are going to want to get, if they can, and he's going to be very diplomatic about it as he was yesterday, but they really want to point to federal spending and what they call excessive spending.
Anne-Marie, just quickly, this is something Lisa and I want to talk about in just a moment, but the president expected to propose a 5.2% raise for federal employees in his budget set to be released on Thursday. This is the largest in 43 years. Now, I understand why he wants to do this, but do they acknowledge that this might contribute to the overall problem?
Well, we'll see, because the president is also going to map out how he thinks they can bring the deficit down. And probably there's been a lot of calls from individuals that work in the federal government, which is a huge employer, because inflation is going up. They want to see their wages go up.
Yeah.
But whether or not it's this issue in terms of federal wages, or if it's going to be he's going to call for a tax over those $400,000, or going to call for quadrupling the tax on share buybacks. None of this will get through this Congress.
AMH, thank you, and well said. Anne-Marie down in Washington, D.C. And let's be careful about framing that point being part of the problem. I mean, for the Federal Reserve, I think everyone's going to want that pay rise against the backdrop of higher inflation, without a doubt. But this is the pass-through conversation that we're talking about. This is why this can last longer than people think.
I don't think Americans understand this. The IMF had a great bar chart in the last 42, maybe 48, maybe 72 hours, how alone the United States is in fiscal expansion as a COVID solution. It's shocking to look at that chart.
There was a story about 6 months ago about members of the European Central Bank, researchers who are asking for a raise, and the central bank pushing back and saying, we don't want to be part of the problem, right? And so this just sort of highlights the reality where, you know, in order to maintain a quality of life, you need to have a wage increase.
I mean, what's so important here, John, is we've got this event here at 10 o'clock with futures up fractionally in that. Then we have the surveillance nab, and we've got to put in place what really matters now.
What's that?
Which is the countdown here to where AC Milan takes out the tots.
Let's not talk about Milan Spurs
because
later.
AC
hoping to avoid
they're
that.
up one goal. They're up one goal right now, right?
Is that the countdown clock for Milan Spurs later?
Yeah, you know,
we should have gone to this game.
We tried. It was blocked.
Wasn't approved. Wasn't approved.
so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it's very different, and it's not something people have had to operate in for a long time.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What a session yesterday. Let's pick up on some of those moves and start with the equity market. 3-day winning streak. Well, we snapped that, didn't we? Your equity market now totally unchanged on futures. We snapped that 3-day winning streak yesterday on the S&P with a 1.6% move lower. The banks got absolutely hammered. The financials underperforming. The banks down about 3.7% on the S&P. Wow. Confronting this move in the bond market, your 2-year through 5%. And we had some weight to it, up another 3 basis points, 5.04%. The difference between the 2-year and the 10-year, more than 100 basis points, negative 107 this morning. That curve inversion gets deeper. It gets deeper with the 10-year really not doing much, Tom. Your 10-year right now, 396.97.
Moments ago, rounded up. I'm going to do that to 3 digits only because Kelsey Barrow's here, negative 108 on the 2-10 spread.
Chairman Powell opening the door to 50 basis points and driving a much, much stronger dollar as well. Euro dollar looks a little something like this on the euro side of things, just a touch weaker by 1/10 of 1%. 105.39 on euro dollar. Bramo, dollar stronger, yields higher. The chair opening the door to 50, and we're at the mercy of payrolls on Friday and CPI next week.
It's soup. That's what it feels like right now. It's soup. And we're going to go to actually a soup maker in just 1 second, Campbell Soup.
Nice.
Like that.
Right, that was just perfect.
I think that I'm going to get kicked out. I'm not going to be here next week.
Did you have, was Campbell Soup inflicted upon you as a child?
Hold on a second. We're getting there.
Do you think in an Italian household, my family ever reached for a tin of soup?
Just how he gets like Gorgier. He gets like Gorgier with it.
That is
absolutely
sinful.
All right, well, we'll get there.
Sinful.
A lot of other people, including my home, did reach for a tin of soup because I didn't grow up in a culinary panacea and culinary heaven like Jonathan Farrow. And honestly, I wish I had, but let's go there. Let's start with Campbell, which is at the bottom. Those shares popping 1.7% because lots of people reach for soup. And they beat expectations. You saw adjusted earnings per share at 80 cents versus a 74-cent estimate, and seeing better than expected net sales for the full year, up to 10% of a gain versus 7 to 9%. Okay, on the margins, is that going to be considered a staple? John would say no. Other people who are classic Americana would say yes. We see WeWork shares popping 7%, yay, but they are down 20% year to date and down 80% or more last year. So it's coming off a pretty low base, and this comes after they said that they were going to be in talks to raise hundreds of millions of dollars in capital to support the business. Are we there in the adapting and adjusting phase? And Tesla, wow, those shares down 1.3%, not the biggest move in the world, considering that U.S. auto safety regulators have opened an investigation into reports of steering wheels falling off.
That's not good.
I mean, it's just not what you want to hear. They said,
Are they supposed to be detachable?
No, no, I don't think that steering
wheels.
wheels
I don't, because I learned this in Formula One. They change them all the time.
Sure, they're doing an F1 change.
But is it Tesla got a pin there where you can?
No idea.
I think that it's about the screw coming undone. I don't think you can really take car tips from Formula One. I'm just suggesting.
Certainly can for this show.
You got me reminiscing about tomatoes. I still remember, I can still smell it.
Oh, here we are.
A truck of tomatoes in our little town in the south of Italy coming up the road and all the nonners leaving the high rises, coming out and buying them. And then we had these oil barrels out the back in the car park, and you used to take a winter's worth of tomatoes. You'd cook them overnight to make the sauce. They'd be there for days. I could still smell it coming up through the balcony. And you'd make jarred tomato sauce to get you through the winter.
So what do you do in the aisle? This is really important. We're going to stop the show.
That's what you do when you have no money in the south of Italy to get through it. You don't reach for the
So
tip.
when you go into a
make
whole
enough to get you
paycheck,
through
John,
months and
in
months
the
and months.
summer, this is important. When you go into a whole paycheck in the summer and you see fancy, homegrown Hamptons tomatoes
no idea
at
what they're talking about.
$15
Forget
a
it.
pound, how do you react to that?
It's ridiculous. It's ridiculous.
I assume that it also wasn't. My grandfather grew tomatoes in his backyard, and every time I went near them, don't touch them.
There was no sharing.
No, I mean there would be, but at the right time.
Very different.
But not, yeah. Anyway,
This was a nice pivot. I like that. I could tell you more stories in the future. Maybe we can do a segment.
I'm
on
the
Bloomberg
only
Radio.
one in America who went to college and the food got better. That's how bad. That's how bad. It's a true story, folks. That's how bad my mother
Can't say
was.
the same thing. We're lucky this morning. We've got Kelsey Barrow from JP Morgan with us. Now, Kelsey thought she'd get a clean slate, come here to speak on behalf of Bob Michael and the team. Then Bob Michael got in there first and said this to Bloomberg. So, Kelsey, I've got no idea what this is about, but here's the quote from him. He thinks that if we go back to 50, it would be pretty confusing to the market. I hope they don't do it. I hope they're willing to run a string of 25 basis point increases. Now, Kelsey, thanks for being with us. The chairman's opened the door to 50. How problematic is that?
Yeah, so if you think about the way that Powell's been communicating about getting restrictive, right, there's three dimensions to that. There's the pace, there's the level, and then there's the duration. And what Powell has been doing for months now is saying, okay, we've hiked a lot, and so don't worry about the pace so much. It's about the level that we get to and the duration at which we stay at that restrictive level. Yesterday, he essentially threw that out the window. That is confusing. And I think the key takeaway is that if we are going to consider re-accelerating to 50 based on the data, and they are very data dependent, the risk of a hard landing does go up in that scenario. And the yield curve is telling you as much. What we saw yesterday, 12 basis points higher on the 2-year, flat on the 10-year, break evens narrower, the yield curve, 2s, 10s getting to minus 100. That is the risk of over-tightening that the bond market is picking up on. And that's also why you're seeing very sticky resistance on 10s at 4%, which is something we've been watching and saying, yeah, people are interested at bonds, even in this repricing. The yields are there, and the diversification benefits are going to become even more important if the Fed is going towards that hard landing scenario.
Ben Emmons agrees with Bob Michael. He writes this morning about the importance of the level we're at right now. Does that level indicate restriction? Does that level indicate not the drama of super restrictive, but that we're finally at levels that really click in?
Well, this is obviously the debate. Now, we think that we are getting to levels that are sufficiently restrictive. So last year, the thing that I was always quoting was the real Fed funds rate. So saying that the Fed wasn't going to stop hiking until the real Fed funds rate turned positive. So essentially, you needed the Fed funds rate to move above the level of inflation. We are making progress on that. You know, if you look at core PC, it's around 4.6%. The Fed is now expected to get to 5, maybe 5.5. That's going to be a significantly positive real Fed funds rate. And I think we have to think about the way in which policy impacts the economy. It impacts housing first, then manufacturing, then consumer and labor. And it's actually playing out in that traditional way. Housing, home prices have been deflating for 6 straight months. Business investment is starting to rolling over. Now, what's only left is the consumer and the labor market. It just takes time. We have the patience as long-term investors that the Fed may not have the luxury of having in this moment.
Yeah, I was going to say perhaps patience that the Fed doesn't have. Right now, I'm looking at a 10-year yield of about 4%, just under that. And you were talking about value in bonds. Are yields at this level on the longer-term debt instruments pricing in a soft landing of sorts, with rates remaining higher for longer and no crash?
Well, I think that with the yield curve, this inverted, you are looking at a rates market that is suggesting the risk of hard landing is rising. Now, where I think the discontinuity is really more in the spread market, so in credit. So spreads are still on the narrow end of the recent ranges and of history. So that's where I would say more of the complacency is. But I think in the rates market itself, I think you are seeing the risk of over-tightening playing through within the very inverted yield curve.
I guess to put this another way, there's a feeling that even if we get some sort of recession or some sort of landing, aside from the no landing idea that people were talking about for a while, that we're going to have higher rates for longer. And that is a persistent theme, regardless of even a crash. Do you agree with that? Do you think that if the Fed does crash the economy, we will still end up with higher terminal rates for a longer period of time?
Yeah, so we do think that we're in a new regime. And the starting point of that new regime was the fact that this is the first hiking cycle in 30 years that the peak of that hiking cycle is higher than the prior one, right? So we were having higher or lower highs and lower lows for 30 years. That's the bull market of fixed income. We are now going in the opposite direction. So this is a meaningful shift because the next time that the Fed cuts, we don't think it's going to be back to the zero lower bound. So there is some changes that are happening here, but those are slow moving. There are still going to be cyclical shifts in yields throughout our broader structural view that we could be entering into a phase of higher highs and higher lows.
Let's pick up on that, because I know Bob's given it a lot of thought as well. Kelsey, you and the team, are you thinking about repeated cycles of that over the next couple of decades? Is there reason to believe we've got tailwinds for it?
There are some reasons to believe, and obviously these are very abstract topics, things that we're not going to know until very, very far into hindsight.
Yeah.
But there are tailwinds as it relates to demographics here. We think that inflation structurally is not necessarily going to struggle as much to get to that 2% level. So if you think about pre-COVID, but post-GFC, it was very hard for the Fed to achieve 2% core PCE. In fact, on average, it was about 1.5%. So we were missing it to the downside by about 50 basis points all the time. Now, I think you can say maybe things have started to shift because of deglobalization, because of other factors, that it will be easier for the Fed to get to that 2%. You know, we're not suggesting a materially higher regime for inflation and rates, but it is one that is shifting over time.
Could be the last 30 years in reverse. TK, this is a major call coming from the team. Kelsey, Bob,
This
over at
is,
JP Morgan.
and the call here is you guys aren't leverage players, but that's a huge part of the alternative investment in fixed income market that is utilizing leverage here. Did they get hammered yesterday? Is there a misuse of leverage right now?
So I think the strength of the move in twos yesterday clearly shows that some people were offsides. And there are positions that needed to be cleaned out. How's the Austria bond doing?
Oh, thank you.
Kelsey, you know what? That's the perfect place to leave it. Kelsey Barrow of JP Morgan Asset Management. That was golden. TK, how is that Austria bond doing?
Well, I can't retire. Other than that, John, I'm going to be here forever. You're going to be retired before me. But, you know, it's brutal, but it speaks to long duration. I'm not talking about 97 years. I'm talking about people at 11, 10, 12 years. They took some losses.
But it also speaks exactly to the point that Kelsey Barrow is talking about of regime change, that we were at a time when Austria could sell a zero coupon, 100-year bond, and people bought it and then bid it up beyond 100 cents on the dollar. And now we are looking at a scenario where that is absolutely out of the question and possibly will look like a complete throwback.
They were the years of fixed income for capital return to not for income.
Exactly.
It was like that hot potato you wanted to sell to a greater fall because you had no intention of holding that to maturity whatsoever. And now I feel so sorry for the person who's just left with it. Just sort of like sitting there.
What are you
talking about? Tom. You know, waiting to see if you're around for it.
will love
it. Mature, 21, 10.
Tenors, 21, 20.
Happy third birthday.
Whatever. Terry Holmes of Pangaea coming up. Kelsey, thank you. This was great. Futures down a 10th. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In less than 5 weeks, Federal Reserve Chair Jerome Powell has changed his tune. On February 1st, Powell said the disinflationary process had begun. But on Tuesday, he told a Senate committee the ultimate level of interest rates is likely to be higher than anticipated. Powell says he's ready for faster monetary tightening if economic data justifies it. In the UK, Chancellor of the Exchequer Jeremy Hunt may give companies extra tax relief on investment spending. Hunt's looking for measures to boost economic growth in his spring budget. He's under pressure to act because Britain's flagship corporate tax break expires on April 1st. The White House has endorsed a bill in Congress that could give the president authority to ban or force a sale of TikTok. Now, that could break a deadlock over how to address privacy concerns around the popular Chinese-owned app. The bill doesn't mention TikTok, but the video sharing app is the clear target. It has about 100 million users in the U.S. The embattled Adani Group has taken another step to regain investor confidence. Bloomberg's learned the conglomerate has repaid a $500 million bridge loan. Some banks had balked at the refinancing, the debt following a report from short seller Hindenburg Research in January that sent Adani assets tumbling. And the most popular place for the super rich to own a home is New York. That's according to a new report by data firm Altrada. Now, the report looks at those with a net worth of over $30 million. London finished second in the survey, followed by Hong Kong and Los Angeles. The U.S. took 14 of the 20 places on the list. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors who learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
We lack, at this moment in time, a holistic interagency, whole-of-government approach. So instead of playing whack-a-mole on Huawei one day, ZTE the next, Kaspersky, TikTok, we need a more comprehensive approach to evaluating and mitigating these threats posed by these foreign technologies from these adversarial nations.
That was Virginia Senator there, Mark Warner, on the latest effort, perhaps to take a step closer to banning TikTok. Who remembers when the former president came like this close to forcing a sale to Oracle and Microsoft? Do you remember that?
I remember that.
It was like years ago.
Yeah, it was.
Literally like a decade ago.
I haven't talked to the Senator in a while, but this guy is first class. This guy was a scrapper, a hustler out of Georgetown. He failed at business, And then he got successful with Nextel and cellular phones and all that, and made a pot of money. But what I'll always remember was the shock of the Douglas Wilder win in Virginia, John, which was stunning at the time. This guy not only could do the tech mumbo jumbo, but he could manage winning political campaigns as well.
So what do you make of this bill?
I think they're, as the senator says, they got to get their act together and get holistic, and that's a tough thing to do. And make
Join the dots.
Just connect the dots of our technology in a nation that instinctively doesn't want to do that.
I'm trying to work out if this bill really just passes the buck, though. To
Yeah,
demonstrate.
absolutely.
It's like,
Oh, yeah.
There's the tools. If you need them, you make the decision. I thought this was going through CFIUS as well. What's happening with that, Lisa?
They said they're still waiting for the full CFIUS review, so we'll see what happens. The White House has endorsed this bill, not necessarily banning TikTok, though. Again, what is the popular pushback? I keep going back to Footloose, and I know that this is perhaps anachronous, but I do wonder if there is this feeling of, don't keep us down, the young people, to the politicians saying, hey, Chinese are
Is this because Kevin Bacon did a Super Bowl commercial? Is that what this is about?
Maybe that's
well,
what
I mean,
it's about.
I mean, it sounds
she-
silly and flippant, but it's actually true. Like, there is this feeling, right?
People don't understand this. Bramo's house, they don't watch a football game, they watch a commercial. So you see Kevin Bacon on there, and you're singing Kenny Loggins, right?
Well, we do watch the commercials. That's all I'll say. That's it.
You don't watch the game. You turn
I
the
watched the
volume up.
game, but the commercials.
You're there for the commercials. That's fine. Lots of people are.
I mean, I'm there for it all. It's just great.
They're
but,
right.
but
It's
look,
just
come on,
one.
don't
I'm
you
usually
watch?
in bed before half time.
But don't you watch the commercials and you watch the best ones? You see kind of what they
I appreciate
are
the
trying
art that goes into a good commercial.
Exactly, the art, what they're trying to appeal to.
How do you convince people to eat food that poisons you? All that kind of stuff is amazing. Love
You're
it.
a food
Just
kick,
great.
my goodness.
Terry
Back to the
Haynes
top
signed
of
up
it.
for this. Maybe he's still with us. Founder of Pangea Policy joins us right now. Mr. Haynes, on what's going on in Washington. Terry, I got to redux what I did with Amory Horton earlier, which is today the House Financial Services Committee with Chairman Powell is a different committee. We have gone from Maxine Waters of Los Angeles out to Mr. McHenry of North Carolina. That's a wow shift. Terry Haynes, what is MAGA monetary policy? President Trump and those associated with him, like the congressman from North Carolina, what is MAGA monetary policy?
Well, first time I'll disagree with the premise somewhat. Mr. McHenry is a very solid conservative, but I wouldn't put him kind of as a MAGA crowd sort of person to begin with. Secondly, what that committee is largely going to do is largely going to support Powell. You'll see the same kind of split you did in the Senate yesterday, where Republicans will generally say, keep pushing, get the job done. Democrats will be very concerned about the impacts on the vulnerable and the less fortunate, be concerned about the impacts on the housing market and the like. And remember that progressive Democrats generally didn't want Powell in place, even though the Biden people were pushing him as a relatively dovish character. So now that they've gone hawkish, progressives feel free to attack. Yes, that's largely what you'll see today.
Terry, I had the honor of being with Spencer Abraham the day our energy policy as a nation went down in flames. This is years and years and years ago. Can we make a technology policy, or is it like energy where we're just not going to make a TikTok policy?
Well, we're not going to make a TikTok policy. I think what you see is really kind of a twofold punch here. One is you're seeing the ramping up of investments in manufacturing in critical areas. I mean, think about this as not a lot different from what we've done in past major conflicts. And you're going to combine that with as Senator Warner, I think, accurately says, a bit more holistic approach on which technologies might be harmful. Technology as part of national security. On top of that, you'll still have the CFIUS process, which identifies potentially problematic investments. So, that's really the policy the United States is developing. Is it comprehensive? It's comprehensive in the sense that it addresses difficulties, but that doesn't mean we're going to have a full board technology policy. I think no.
Terry, it seems like people are highly skeptical that the U.S. is going to ban TikTok. Pretty much everyone has come out and said they're not going to do it, especially because 2/3 of American teens are on this app and doing dances and other such joy. I am curious from your perspective then, what is the ultimate goal of this? If it's not to ban TikTok, it introduces political liability if they don't do anything and they raise the risks. Is it just to try to get a sale?
No, I told people yesterday that I thought this bill was 75% likely to become law, firstly. And, you know, bills get introduced every day, and I'm usually in the business of telling people that bills don't matter. This is different. Warner and John Thune are very serious people. You got already a dozen Senate co-sponsors. You got the Biden administration falling in behind. You know, the whole idea is to not do a ban TikTok, ban this, ban that, but to put together a process that identifies potential threats across the board. That said, I think TikTok gets banned. I mean, that's instinct and nothing but. But the you know, you've already got half of the state governments telling folks that, in addition to the federal government, telling people to take it off devices. I think it absolutely gets banned in the end. Sure.
What does a TikTok ban look like, Terry?
Well, the app goes away. You know, it basically gets flushed out of the United States system, and you know, kind of the algorithms are. You know, the algorithms are blocked, you know, that sort of thing. I mean, every technical measure taken to make sure that it doesn't infiltrate this country gets taken.
Terry, have you got any insight on just the lobbying effort taking place down in Washington at the moment? I can just imagine the team at Snapchat, Facebook, getting really excited about these developments, Terry. Any insight on what that looks like right now?
Well, the teams are really forming up right now, John. Firstly, you know, they're trying to figure out exactly, you know, whether this helps them or hurts them, to be honest. But you know, one of the things that will cause a lot of people, because there are a lot of people in the tech world and the lobbying world in Washington, some concern is precisely the broad-based nature of the Commerce Department-led review that Senators Warner and Thune have put together, and. You know, and yeah, I can see a lot of other folks salivating about this, sure, but at the same time, as I say, this legislation is not about whether or not to ban TikTok. In fact, I heard Marco Rubio say last night that he was generally supportive of what Warner and Thune were doing, but Rubio has the only bill that would actually ban TikTok, so there's going to be some elbowing under the basket on that. You know, they're all going to be concerned about the breadth of the review and, you know, whether it's TikTok or not, the breadth of the review, exactly what the criteria are, all that sort of thing. And this is not going to be some snap thing that happens. It's going to be a developed process that goes on for some months.
Terry, wonderful to get your perspective on it. Just a bit more clarity there from Terry Haynes of Pangea Policy. Seen a big rally in Snap over the last 3 days. You've seen that, Lisa, the last couple of days? Big pickup.
Yeah, how much are people expecting some of the other social media outlets to benefit significantly? Meta also, although there are those job cuts that also helped support some of the gains there. You do wonder what the lobbying is like. I love the idea of, you know, them going down and saying, like, you got to protect the security and the mental well-being of children.
We want to make the world a better place.
Exactly, I was just about to
Give
say.
us more business.
Give our children a greater sense of, you know, being together with their peers and not just, you know, floating above a social media regime that is isolating them further, you know, that kind of thing.
Totally on board with that, Tom. Nope, okay. Coming up next, Alicia Levine.
I just totally don't get it. How are we going to ban the technology? I mean, I just don't...
Well, you ban the company, not the tech. I mean, someone else can try and do something with the tech, can't they? I mean, they're going to.
I don't know. I tried it, you know,
You've
for
got
an
Reels
hour.
at Instagram. What have you got? Shorts at YouTube?
Oh, I'm on my phone for an hour.
Maybe read a book.
Read a book. How original. I'm on a phone. I'm like, really? This is TikTok? Really?
Must eat better. Read more. What show this is turning into.
Seriously.
Future's unchanged. This is Bloomberg.
Welcome back to a special BNP Paribas Open update for Bloomberg TV and Radio. From Tennis Channel, I'm Erin Coscarelli. On Tennis Channel daily at 1 p.m. Eastern.
So can you talk to us maybe about like how important data targeting or targeting of an audience actually is? Because I think we hear these things like, oh, it makes it harder for advertisers if they're not able to track your data. Why is that so important? And like, can you maybe give us some numbers around how valuable a targeted ad is versus an untargeted one? I don't even know if untargeted ads exist on the internet.
Oh, yeah. Well, and just on to sort of add on to Tracy's question, like, let's say I go to golf.com.
Yeah.
Okay. The ads that I get, like, how much is it? Oh, he's on golf.com. He probably wants to read about golf, as opposed to ads that I get that maybe, you know, the last 10 sites I went to is like pets.com or something like that.
Yeah.
And so how valuable is it for golf.com to be able to know that I also like pets?
I mean, there's all sorts of open and unsolved questions about the value and precision of online advertising. The classic example is like you go and you buy a pair of sneakers and then all you see are ads for the same exact sneakers, like just following you around the internet, right? It's like, I just bought these. Why do you, like the world's biggest tech companies that so supposedly know a lot about you, like can't solve that
You bought one pair of sneakers.
Yeah,
you must
you
want
might want
more.
another one, right?
Well, I do, but I definitely don't need a second stone.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Markets stay healthy, the consumer continues to spend, and wages continues staying strong. This is not the size of a typical bear market.
A 50 basis point hike is actually inflammatory or would raise a lot of concerns among markets.
This is really an exercise in central banks and the Fed in particular defending their credibility.
Friday's payroll number is really going to be a key print.
This week and the next week are going to be important weeks for getting some sense of where is this data, what is the data telling us.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. With us, a 210 spread, that indicator for equities, bonds, currencies, commodities. John, moments ago, a print of 108. We may get a 109 print on that record curve inversion.
Unreal crazy. Pick your word for it. Your 2 years doing the heavy lifting. Your 2 year up another 3 basis points, 5.04%. For many, it wasn't just that Chairman Powell opened the door to 50. He lowered the bar for 50. That's what Citi's Andrew Hollenhorst is writing this morning. Others saying the same thing. What do we need on Friday to get 50 basis points? Deutsche Bank says 300K on payroll, 0.4% core CPI next week. They think this market's going to go with 50.
Let's go to the historical perspective, Jess. He is a friend.
That's beautiful.
Yeah, I know.
What's
He's
the next
been
line?
a good friend of mine. But lately, something's changed. Jesse's Girl, 1981. We're back to Volcker. But I'm going to say this
I didn't
is
even recognize it.
This is not an analog to Paul Volcker. I really take issue
Let's
with that.
be clear. They don't think we're going back to Volcker. They think we've got Burns. I mean, to say that this is Volcker
I
would be
agree.
giving
Well
them some
said.
credit.
Well said.
This is about a flip-flop, and that's the problem. Step down to 25, risk reintroducing 50, a month later, 1 month's data,
Yes.
and all of a sudden backing away and reintroducing 50.
I actually went back once, not recently, but a couple years ago, and looked at the actual Arthur Burns shifts, and that's what Greenspan solved. Greenspan invented measured 25, 25, 25, and now we risk what John says, Lisa, which is a little bit of uncertainty.
If he doesn't go 50, though, then what, right? I mean, this is the issue. You've got Andrew Hollenhorst over at Citigroup. John was
What did he
mentioning
say?
him. He now expects a 50 basis point rate hike at the March 22nd meeting because of what they said and what we heard yesterday. He also sees a terminal rate of up to 575, up from a previous expectation of 550. On one level, this is deliberate, right?
Right.
But then what happens if the Fed doesn't deliver that? Have they already flipped and flopped in the eyes of a market that has taken their guidance from the
Right.
rhetoric that we've heard?
Report on what you saw in the IG and high yield market given yesterday's festivities.
The same thing that we saw in equity markets, really sanguine look at what
Why,
potentially could
John,
happen.
why did that happen? I
No
still
idea.
don't have an
It's
answer.
been the story of the year so far. Why is tech leading?
Right.
Year today, why did the NASDAQ rip? We've had a 100 basis point move at the front end of the curve in a single month.
Right.
You'd think stocks should be cratering. You'd think that would hurt.
Oh, 2 minutes. I just got elbowed by Alicia Levine. She wants to get in on the conversation. Let's do the data check right now. John, I got to look at 108 basis points on the vanilla spread. We're supposed to be there 8 months from now.
I'm just going through that note the City just dropped after Lisa pointed it out. 255 is what they're looking for on payrolls. 0.5 month-on-month core CPI next week. They think that's enough to get it done. My question will be on Friday. We'll all be asking this. If we have something like 180, 200, what does it mean? Because we then go into the quiet period. This is the problem when you open the door to 50 again. It's not just the size of a single hike, it's the communication. Once you downshift and you reintroduce another bigger hike, it's like, okay, you're going to go 50 on what, and then what? Then what? What do you do after that? And after that?
Yeah,
What's the
maybe
glide path look like?
I guess that here's my issue is if you want to get to 575, why not just raise to 575 and hold it there? Like, what is the point of going slow? I mean, this raises another issue.
Well, that's
It's
what
like,
Bullard said, and
Right.
Ilarian's alluded to that.
Right. So at a certain point, if they just say, okay, we're going to
Right.
raise it to this, we're going to hold it, we're going to see
No.
what happens. Why are you crying, Tom?
John, I'm not crying. I got elbowed by Alicia here. I
Just
don't. Is
bring
there any
Alicia
blood?
in.
Can you
She's
see
been
any
very
blood?
patient. Bring
She's
her
been
in.
very patient. Alicia Levine with us right now, BNY Mellon. She's over there. It's like the Bramo cam was on her while you were talking, and she wants to jump in.
Good.
Respond to what we were talking about. This hurt.
Look, I think what Powell did yesterday was the right thing to do. The data has been hot, and if he didn't put 50 on the table, it then threatens a further loosening of financial conditions, which will unanchor inflation expectations. So he had to put it on the table. I actually think it was the right thing to do, but now the problem is he's locked in, because if they don't go 50, right, it's been a series of locking in. The Fed talks too much. I have thought that throughout this whole cycle. There's too much talking, too much talk of disinflation 8 weeks ago, 13 times. But in the end, by putting 50 on the table in the near term, they're almost forced to go through it. I think a 200 number on Friday would do it.
I want to pick up on Lisa's theme of this morning so far. If 200K gets it done, it's a pretty low bar. Why are stocks so resilient?
That is confounding and the question of the year. And to your point, why was NASDAQ leading yesterday? So let's just point out that even after the price action yesterday, stocks were where they were on Thursday. And the disconnect between the bond volatility and what's happening in the stock market is ever widening this year, year to date in 2023. The market has been remarkably resilient, as have credit spreads, as you've just talked about, which is what's holding up the market here. So I think what the market is seeing is that ultimately that 10-year is having a hard time over 4%, and ultimately the 10-year is going to move lower because a slowdown will be coming. The Fed's going to wind up pushing us into recession.
So I get a lot of hate mail about being too gloomy and people who think that I always am glass half empty and just, I should go have a little bit more fun. And so some people will say that, if you take a look at what's been going on, let's try to look at the bright side. Maybe stocks and credit spreads are seeing a picture that, the rate volatility isn't. Maybe there is this resilience. Maybe that strength is, going to carry through even if rates do go up to 6%. Do you buy that?
So I do buy the thought that the economy appears to be less sensitive to rate hikes than originally thought. I mean, we are now at 450, 475 in 12 months. wither the crisis, wither the great knock-on effects. We're nowhere, okay? And I think that surprised a lot of us who've seen other rate cycles here. So that has to do with the fact that most of mortgages are fixed rate at 3%. People are making the spread on a 5% 6-month treasury, right? So they're actually making money on this trade. But even if the economy is less resilient, the Fed will probably have to go higher and will eventually work. It's just going to take longer. The data and the real economy continues to be fairly strong. You're seeing weakening in certain parts of the economy, such as housing. Clearly, commercial real estate is at risk. That's flashing a warning sign here. But that's really the beginning of it. It just hasn't happened yet. As long as labor is strong and as long as workers are getting wage increases, which they are, you can keep this going further.
So what do you do with the idea of a 6% Fed funds rate? What do you do with a 50 basis point rate hike on March 22nd? How does that change what you buy?
So it's a really interesting thing. So far, cyclicals this year have worked, as have growth, right? And I think that begins to change a little bit. You have to think of this as if the Fed has to go to 6% or even higher, it's not our base case, but you have to start opening your mind to the fact that it could happen. Then you start having to see a recession by the end of the year or even into 2024. The confounding part of this year is that the recession hasn't happened yet. And it's very hard to predict with the strength we see in other sectors, such as the service sector, which continues to hold up the economy. But you have to expect it within, let's say, the next 12 months. And with that, you do start asking the question, will cyclicals continue to outperform? And that's really where you have to go with this. Because the defensive stocks have been terrible this year, right? Healthcare's been tough, staples have been tough, utilities have been tough, and the cyclicals have ripped. So the question is, what happens if the recession really starts to be priced in?
I'm not going to mince. On International Women's Day, there are many women that have provided leadership, and you have with bulletproof mathematics and education. I mean, your path here was painful in terms of like the lean over the desk. Right now, we are at a moment where we've got massive first and second derivative moves, and it comes down to Nassim Taleb's math. The gravity's back. And as Taleb says, you got to have skin in the game, which means all the shadows are out there, all the worries are out there. And you study it on a tail with a Poisson distribution. We're not going to go into the math this morning.
You
but
are.
No, I'm not. I'm not going to go into the math this morning. But are we there now where we've got legitimate tail risk of, as Alarian would say, the unknown unknowns out there?
Yes, we do. We've always thought that simply because we don't think you get out of a rate cycle that quickly. I think what's unspoken in this conversation today is the debt ceiling. That could change what the Fed does rather remarkably and rather quickly as well. And the fact that the U.S. hasn't had a recession in the third year of a presidential term because it's an election cycle coming up. What happens to the pressure on Powell if we actually get that recession by the end of the year? Can he finish the job? Yeah. I don't think Powell's Burns yet. The question is, will he be Burns in the future? I think for now, Powell's sticking to the Volcker playbook, and I think he's doing a pretty good job at it. The question is, if we get that recession, if your unemployment rate goes to 3.8% from here, which doesn't feel like a lot, he'll be getting pressure from the right and the left.
You're just much more diplomatic than I am, Alicia. You're going to stick with us. Alicia Levine there of BNY Mellon. To Alicia's point, this tension's happening in the semi-annual testimony with unemployment at 3.4%. To Alicia's point, what happens, Tom, when it starts climbing and they're still pushing because inflation's still above target?
And I'd overlay on that this continuing belief that we're working with, as Alicia says, the Volcker playbook. It's not an analog. This is not analog back to 80s. It's original.
Right now, Powell's between a rock and a hard place. I think what we just heard about the idea of an election cycle is going to be very interesting. Do we start to see if there's a little bit more weakness, all of a sudden pause, all of a sudden, I don't know, like all of a sudden complete,
I can guarantee you one thing, Senator Warren's going to find some company pretty quickly. Alicia, you're going to stay with us if that's okay, because we've got an ADP report coming out in about 4 minutes' time, and a lot of people sit around the table on Wall Street and say the ADP report doesn't matter, and then it comes out and people trade on it
every time,
every single time.
This is true.
So Mike McKee's going to break that data point down for you. Alicia's going to respond to it in about 20 minutes' time. We'll also catch up with the brilliant Diane Swong, the chief economist at KPMG. Looking forward to that conversation. If you are just waking up, lucky you, this is what your market looks like. Equity futures look like this on the S&P. I mean, I'm jealous. I'm not having a dig. I'm just jealous. Like, I would love to be just waking up. Can't sleep in these days, Bramo. You've got the same thing. Can't get past like 6.
Well, and if you wake up every day at 4, what do you
Saturday
think?
mornings are like 6:05.
Maybe if we have, better
Let's
food
go.
to eat and
Anyway,
read more
I
books.
promised you some price action. Futures up by about 0.1%. Yield on a 2-year, 5.03%. On a 10-year, 3.95. The spread between the two, negative 108 basis points. Unbelievable. Deepest yield curve inversion going back to the early 1980s. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Bond traders have boosted bets that the Federal Reserve will speed up the pace of interest rate increases. That's after Fed Chair Jerome Powell testified before a Senate committee. Powell told lawmakers he's ready for faster monetary tightening if economic data justifies it. Interest rate swaps indicate traders see a half-point hike is more likely this month. President Biden's new spending plan will include what officials call one of the nation's biggest peacetime defense budgets ever. The total will exceed $835 billion. It includes big increases for weapons buying and research and development. In the former Soviet Republic of Georgia, riot police used tear gas and water cannons to disperse protesters unhappy over a so-called foreign agents bill. The measure would curb the influence of groups that rely on funding from the U.S. and Europe. Critics fear Georgia is sliding away from the EU and NATO and is increasingly pro-Russian. U.S. safety regulators have opened an investigation into Tesla's Model Y SUV. The National Highway Traffic Safety Administration received 2 complaints that the vehicle's steering wheel can come off while you're driving it. And the probe covers about 120,000 Model Ys that were built for the 2023 model year. And the German sports shoemaker Adidas has slashed its dividend and shaken up management. New CEO Bjorn Gulden is personally replacing the head of global brands. Now, meanwhile, Gulden is floating the idea of selling the $1.3 billion of Yeezy gear and donating the profit to charity. Adidas halted sales after cutting ties with the rapper known as Ye. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Moment news breaks. No one covers the world like Bloomberg.
6 people have died from these latest quakes, adding to the 41,000 plus people who've died in those major quakes 2 weeks ago.
A top Sam Bankman-Fried associate said to be nearing a plea deal.
How does that help build the case for the prosecutors against Sam Bankman-Fried?
Biden is here to say we will stay with Ukraine until the very end, and that's really a show of support as well for the allies.
Bloomberg, your global business authority. This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
We don't care about the ADP report.
Nope.
And then we trade on it. Mike McKee has that ADP report right now. Morning, Mike.
John, it is a 242,000 number for the month of February that ADP finds in terms of its changes to the U.S. payrolls. That is up from 106,000, which was their initial report for the month of January. 200,000 was the forecast, so this comes in better. It looks like at this point, most of the jobs created were in medium and large establishments, which is kind of interesting because it's been the bars and restaurants who've been looking for people, but according to ADP, small establishments lost 61,000 jobs. Also losing jobs, construction. That's something people have been waiting for as the housing market slows down. 16,000 jobs lost, but a lot of that made up for it in manufacturing, where 43,000 jobs were added, 83,000 in leisure and hospitality. Not sure how that works with the 61,000 lost in that area. ADP also puts down out a pay growth index these days, and according to them, pay growth for people who stayed in their jobs was 7.2%, which is the slowest pace of gain in 12 months. For job changers, it fell to 14.3 from 14.9. Now, I did some calculations this morning. Since ADP came up with their new numbers, their new system, they have been off by an average of 132,000 a month compared with the non-farm payrolls number from the Bureau of Labor Statistics. So make of all this what you will.
Mike, stick with me. Very briefly, just moments ago, the 2-year, 10-year spread dropped below 110 basis points. Just haven't seen these numbers since the early 1980s. We had some more weight to the front end of the curve. So your 2 years now higher by 4 or 5 basis points. The 2-year yield 5.05%. And what are you seeing on a 10-year? 2-year yield higher, 10-year yield lower by a single basis point. 395. We'll pick up on that story in just a moment. Equity futures, in the face of all of this, pretty resilient, only down 0.1% on the S&P 500. So you've got an upside surprise, 242,000 against the previous month, the revised figure of 119. Now, Mike McKee, people will look at this number and say, okay, like we do every single month, what does it mean for me on Friday going into payrolls? And how close was last month's ADP print to what we got from the overall official NFP a couple of days later?
Well, it didn't make ADP look very good last month because they forecast 106,000 jobs created, and we got 517,000 from the government numbers. Now, ADP's revised theirs all the way up to 119,000. So there's still about a 300,000 disparity between the two. So I don't think you can draw many conclusions from this report about what we're going to see on Friday. A lot of statistical noise in the January numbers. Jay Powell talked about that yesterday. We had weather, we had seasonal adjustments, and we had population adjustments. So it's kind of hard to get a read on what we might get on Friday as well. But it is that is a number that is going to move the markets much more than ADP.
Michael, how will you study the revisions that we see in non-farm payrolls?
Well, it's going to be a matter of comparison now. We got the revisions to January, so we have to look at February. It's very hard every year to compare January to December because of the changes that they make. But now we can compare February to January, and we know that the weather wasn't quite as bad in February in most places as it was in December. January was warmer. So we'll look at all those factors and try to figure out whether it had a significant impact or not. But it's going to be the headline number that is going to make a big difference.
Mike McKee, thank you, sir. As always, Mike McKee there breaking down that headline number for you on ADP, 242,000. Equities a little bit softer off the back of this, Tom, down 0.1%. Yeah. Yields a bit higher at the front end. As I mentioned, the 2-year versus 10-year, that spread dropped below 110. Briefly, negative 109 basis points, Tom, is where we are right now.
I know we've got to get to Alicia here, John, but I just don't know how you can model in quiescence here when you look at what happened in France, Spain, Germany, and the rest. There seems to be a persistent trend here.
It's on to payrolls on Friday, but ultimately, just slowly pricing it in, just a little bit more, a 50 basis point move later this month.
And just as an aside here, Argentinian peso through 200, which is a huge benchmark of the fragility of that nation, 200 pesos per dollar. With the world of Damian Sassar, we'll get to that in another moment. Alicia Levine continues with us right now. Explain as an equity person how I can avoid going to 4.97% cash. Wow.
So we have signaled to our clients this year very explicitly that we're in a regime change for equities here, that what worked in the last 15 years post-global financial crisis of zero rates and high multiples is just not the playbook for this year. And that means to go a little bit lower down the cap scale. It means not to go back to 2019. What we saw in January was, oh, well, if last year was 1974, then this year is 2019. Just grab the same old stocks, and they've sold off 50, 70%, and buy them and they'll rally. We think that's actually a mistake for what the world we're in, which is structurally higher inflation with a structurally tighter labor force and higher rates. That's where you have to be. So you have to be in sectors that do well with higher rates and some inflation in the system.
So a lot of longer-term investors will come on the show and say they don't trade around these data points. They certainly don't trade on ADP. They don't trade on the payrolls report. They collect the data and they adjust their view over time. Is this time different? Do you find yourself trading or making views more dramatically on some of these data points?
So we take big long-term views. We look out 12 to 18 months. We don't trade and we don't advise our clients to trade because trading tends to be the way you kill your equity performance and in other asset classes for that matter. So we take a long view, and the long view here is higher inflation structurally, higher rates structurally, maybe R squared higher, which means you're just going to wind up with the Fed funds rate ultimately when inflation's over 3%. If we're not going back to that 1 to 2% world, that's a very different world for investing, and that's what we've advised going forward. You can't trade around this. It's too volatile.
How do you know when equity markets, when risk assets have woken up to the reality that you're just portrayed?
So the issue is what's rallying and what's working. Right now, what's working is the playbook from the post-global financial crisis of near zero rates. In all of our analysis, that is not the world we're in. Could we get to a place where there's a deep recession and the Fed cuts? Of course we can. But once inflation's in the system, it's very hard to get rid of it. And we just think you're in that world where the cyclicals will work, the materials, the industrials will work, a little bit lower on the market cap, a little more value-oriented stocks. This will work. I don't like using value because right now there are plenty of tech stocks which are value stocks. So I don't like using that because it tends to mean sectors, but just companies that can earn, that have some dividends, and that increasing their cash flow. That's what we're looking for. You can't trade around that. It has to be GARPy, growth at a reasonable price.
Alicia, I'm just sitting here thinking about what's the kind of data point we need on Friday to cause the most amount of pain. Is it a massive miss and a big revision to the previous month? Where would that leave us? Is there enough data in the totality of the data over the last month or so to take that revision and put it to one side and say, well, things are still heading in this direction? Or do we just flip all over again?
So it's a very interesting question because I think the answer to that is that a miss on the number, in the 50 to 100 range, because the market's all in on higher rates for longer. I mean, wherever the market is all in, the pain is on the other side here. And so you now have positioning that reflects that. So it's been a weird market. Every 4 weeks, we're ping-ponging, which is why we take a long-term view, because you can't really trade around it. We've thought, really, since last summer, higher for longer. The Fed will hike and hold. Don't look for the pivot. We knew the pivot was wrong. We knew it was wrong months ago. But
Powell didn't know. You could have told him, Alicia.
Well, maybe he wants to be liked. But the point being, we invest with that view. You cannot trade around the data points. Too difficult.
Alicia Levine, fantastic, as always, of BNY Mellon. Payrolls coming up on Friday. So much of this could change with payrolls on Friday, and then it's on to CPI next week, Lisa, on the 14th.
You asked a great question. What's going to inflict maximal pain? Because that happens all the time, and that seems to be the data that we get again and again. It's like, you thought this? Ha-ha.
Yep. Can I just say, it's International Women's Day, so we try and make the effort to celebrate world-class women on Wall Street. But this lineup in the 9 o'clock would be a world-class lineup any day of the week. Victoria Fernandez across Mark, Oksana Aronoff at JP Morgan, and Bridgewater's Karen Carniel-Tambor. Look out for that in the 9 o'clock hour, counting down to the opening bell. This is Bloomberg.
typically between the time you start and they get out in the farmers' fields is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, starting Monday, March 13th, only on Bloomberg.
Bloomberg Surveillance, Lisa Bramlett and Tom Keene, Jonathan Farrell preparing to get the markets open in the next hour on Bloomberg Television. An historic moment, the yield inversion, a negative 110 basis points right now on the 2-10 spread. Equities churning as we can. And Lisa, we barely talked about it quickly here. Dollar stronger today.
Dollar stronger across everything. If you look at the dollar index, it's actually the strongest going back to late November, which raises a question. Again, where are the pain trades and how much are they going to get unwound in this flip-floppy world of record this, record that, and then ending up at the same place?
The pain is we've got a wonderful half hour. We're going to get through this quickly. Michael McKee on trade and then an important chart. Michael, what do you have on trade?
Well, the trade balance for January comes in at a negative $68.3 billion. That's up from the prior month's 67.4. It's a little lower than the anticipated number, according to the Bloomberg survey. Trade, of course, a little bit less important than it has been in the overall market thinking these days, but it does suggest perhaps a little bit lower GDP profile.
On this historic moment, it's always Michael McKee who delivers clarity, and he does now with the chart. Folks, for you on radio, this is the 2-10 spread, the difference between the 2-year and the 10-year. I call it the vanilla spread, and what McKee has done is establish the timeline of events before this collapse to ever greater inversion. And it can be, as simple as what we saw with payrolls, what we saw with retail sales, bringing it all the way out to Mester Bullard. When did it break, Mike? When did we really break into further inversion?
Yesterday. Actually, we broke into further inversion on about the 2nd of March. But the numbers that came in earlier, when you look at what happened after payrolls, after CPI, after the retail sales numbers, and then, of course, we had Mester and Bullard coming out saying they could have done 50 at the last meeting. The market traded sideways to up in terms of the yield curve. It didn't go down at all. And the only time it started going down again is we got the PCE numbers, and then we had this big drop yesterday when Jay Powell came out and said, hey, I looked at that chart, and I see all these numbers are getting, we're hot in January, so if they stay that way, we're going to have to move. I just want to know, where were you? Where were the markets? Where was this yield curve when all this negative information was coming in that would have told you that the Fed might take that position?
It's a good question, and perhaps it's because Jay Powell did seem to embrace the disinflation narrative until he came out yesterday and talked about the revisions to the data, the backward-looking revisions that made it look like they weren't even making as much progress as they had initially thought. How significant have the revisions been to really reshape the narrative at the beginning of the year?
Well, they do reshape the narrative because we did see revisions that took away a lot of, maybe half or so of the progress that the Fed thought they'd made, but those revisions were revealed on the dates that these other indicators came out. So if you were doing your work on where you think the Fed might be, you probably would have moved at that time. The Fed was looking at, on February 1st, I think, at numbers that had not changed. And so we're doing a little bit of risk management in going to 25, because at that point, the data were telling them they might be getting close to really restrictive, and they didn't want to go too far. Now, the data tell them to do something different.
Michael McKee, moving forward to JOLT survey. We'll see that here at 10 o'clock. Michael McKee, thank you so much. We should point out that, well, on International Women's Day, you can be a reporter who says, well, I got a fancy degree from Chicago, but I know nothing about bonds. And through sheer inspiration and perspiration, you learn about bonds. What was it like, Lisa Abramowitz, your first day in the bond world?
Well, it was in 2007 in August when the commercial paper market was freezing up. So it was definitely a moment of real tension and drama that people don't associate with bonds.
Did you just pile up 15 books around you and just read Fabozzi cover to cover and the rest of it?
No, I called traders, and a number of them cursed and hung up because that was the moment that we were in terms of the tense feeling. And I do wonder, we saw the lack of drama for a decade or more, almost 2 decades. And here we are, and the drama is
getting
back.
very 070. Someone that knows that is Diane Swank. She's chief economist at KPMG. And Diane, I'm just thrilled that you are here today. And I place you in a group with Abby Joseph Cohen of Goldman Sachs, now at Columbia University. And of course, the wonderful Sally Krawchuk as well, who changed securities research at Sanford Bernstein years ago. And then there was Swank in 1985. I think she was out of junior high school at the time. And she was in Chicago landing a job at First Chicago Corporation. What was it like the first day on the job, Diane? I mean, out of Michigan, it was unique at the time, right?
It was unique, and to be honest with you, then I went on to University of Chicago as well. But you know, I rode up the escalator, and I often described the person I was mentoring in the 80s, and that person was me, and I looked like a man in some ways with my short cropped hair, my male-dominated kind of women's suit, and I even had wingtip pumps, which says a lot, although I refused to wear those. I had bow tie, and I took it off. I just couldn't take it anymore, and I put it around my waist, which is kind of me as well. But, you know, until I got to step into, for me, my femininity, my career didn't take off, and luckily that occurred very shortly thereafter, and I had a terrific mentor. You always need someone that is a terrific mentor, and he once said to me, it's not that I'm altruistic, Diane. You make me look good.
What do we need to do forward on International Women's Day? I mean, there's all sorts of cohorts here and debates and that. Ms. Swank, you've lived it. What do we need to do forward to get more women into economics, finance, and investment?
Well, it's really kind of a sad commentary, particularly in economics on the academic side. And, you know, the bottom line is that we need to all be able to step into our truth and who we are. And that is not allowed in a lot of these fields. And that's something that I have a really hard time struggling with, because it took me a long time to do that. I had to work through 2 maternity leaves. My son almost died. I was on TV 4 weeks after I delivered my daughter. I don't wish that for anyone. And the bottom line is we have to acknowledge the biology. And the biology is that women are delivering babies, and you know, same-sex couples are able to have children. We have to support paternity leave, and that is really important. We just don't do it. The fact that our female participation rate and our male participation rate among 25 to 54-year-olds, a group I no longer belong to, is the lowest in the G20, which is really the G19, because we don't include Russia anymore. That is really despicable. Our neighbors to the north, Canada, has a 12% higher participation rate among prime-age women than we do in the United States. So it's here with some, you know, I have a sadness to this day in the fact that I wasn't able to do more, and I still got a lot of work to do for everyone behind me.
Lisa, why don't you pick it up here? I mean, there's some themes there that are really, really trenchant, and how alone America is in this debate.
Well, I want to go to what you managed to accomplish in that time, Diane, which is an incredible reputation and prowess within the economics field at a moment that is highly tenuous, where you're trying to put together a lot of real uncertainty into some sort of forecast. What did you make of what Jerome Powell said yesterday on Capitol Hill?
Well, you know, I thought he finally stepped into where we knew the Fed was, and the fact that all the headlines actually reported the same Chairman Jay Powell is really important, and that is they are data dependent. The data and the narrative has shifted, and that does put 0.5% on the table. Now, could it change? There's 2 more key data points coming out before they meet on March 21st, but I think it's important that he laid out just how data dependent they are and the willingness to pivot. You got another Powell pivot, and that is that we could get 0.5% at this next meeting and that rates are going higher faster. I think that's very important information to have. It's one that we've been arguing, and yes, the data has been out there officially since the Valentine's Day massacre of that inflation number we came out, but the revisions to that were out prior to that, the Friday before it, and we were looking at it going, oh my gosh, this has changed the entire narrative.
Well, is the data that we've gotten since then, and I think about the ADP data that a lot of people are dismissive of, has it confirmed that strength, or is there any sign that perhaps we're going to see some sort of downward revision or some sort of downside surprise in labor market that has surprised for almost a year straight to the upside?
We certainly could see some cooling, and I think we are seeing some cooling, and I think the ADP data is now the way that they've redone it, and I give a lot of credit to Neela Richardson over at ADP for not making it a forecast of the official payrolls data. It is its own data set, but it still shows that there's a lot of strength in wage gains there. That's terrific for wage earners, but to the extent that we're seeing continued upward pressure on inflation tied to demand, which is tied to the wages people earn, that is a concern for the Fed. And I think that data, I mean, we know the month of January, part of the reason ADP's report was so weak was because it is more sensitive to the floods we saw in California. So people who didn't work the whole week didn't show up as much on payrolls in that week that was the survey week. It was not the same for the national data. If they got paid even a dime that week, they showed up on national payrolls. So I do think we'll see some downside surprises as well as we come off this, unseasonably hot January in many ways. But the bottom line is you need the threshold to get us to the Fed feeling like it's actually got inflation under control and that inflation will not become a more entrenched inflation is very, very high. That means their threshold to slow down rate hikes is high right now.
Diane Swank, thank you for joining us today, of course, with KPMG. Lisa Sally emails in surveillance correction. I misspelled Ms. Krawcheck's name, which she would go, Tom, you can't do that.
Well,
Abby Joseph Cohen, Sally Krawcheck spelled correctly on radio. You missed the spelling, and Swank as well.
All right. I will say, I want to just note also that stocks have turned around. They are now positive again, which, I mean, look,
I wasn't going to go there. In this market, can you say so?
I think that that's interesting because the lack of any kind of conclusive move after what we heard from Jay Powell yesterday, after data that kind of confirms that narrative, if you want to have some more data to confirm your narrative, to me, it's just amazing, the resilience, and it continues. And the NASDAQ.
We're going to go to break, and when we come back, will it be red on the screen? I mean, the way we're moving this morning, who knows? What you need to know on this historic day is we did print negative 110 basis points of curve inversion back to 1981. A reason to stay with us through the morning. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In less than 5 weeks, Federal Reserve Chair Jerome Powell has changed his tune. On February 1st, Powell said the disinflationary process had begun. But on Tuesday, he told the Senate committee the ultimate level of interest rates is likely to be higher than anticipated. And Powell says he's ready for a faster monetary tightening if economic data justifies it. In the UK, Chancellor of the Exchequer Jeremy Hunt may give companies extra tax relief on investment spending. Hunt's looking for measures to boost economic growth in his spring budget. He's under pressure to act because Britain's flagship corporate tax break expires on April 1st. The White House has endorsed a bill in Congress that could give the president authority to ban or force a sale of TikTok. Now, that could break a deadlock over how to address privacy concerns around the popular Chinese-owned app. The bill doesn't mention TikTok, but the video sharing app is a clear target. It has about 100 million users in the U.S. Mortgage rates in the U.S. have now risen for 4 weeks straight to the highest level since mid-November. According to the Mortgage Bankers Association, the contract rate for a 30-year mortgage rose 8 basis points to just below 6.8%. Now, at the same time, the group's index of mortgage applications increased. And the most popular place for the super rich to own a home is New York. That's according to a new report by data firm Altrata. Now, the report looks at those with a net worth of over $30 million. London finished second in the survey, followed by Hong Kong and Los Angeles. The U.S. took 14 of the 20 places on that list. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Has slowed down considerably. Credit markets stay healthy. The consumer continues to spend, and wages are continuing staying strong. This is not the signs of a typical bear market. At the same time, we're not expecting this massive bull rally either, because we don't quite see the catalyst there. We do think that equities can drop lower, but for us, it would take a lot to see those October lows again.
Anna Hahn pushing against the caution out there. Actually, Lisa, am I right on this? I thought that Ms. Hahn was quite optimistic yesterday. I thought there was a framework there of own equities.
And basically this idea that perhaps we're not in this bear market that everyone's saying that we're in the bear market rally, she rejects the premise.
I'm not going to give my opinion nor your opinion, but boy, it is tumultuous here. Thank you for being with us today towards an hour and 10 minutes. And, usually I'm going to say that the day after, whether it's Senate day after or House day after, as is today, House Financial Committee with Mr. McHenry of North Carolina, it's a yawner. Maybe it's not today.
What is the question that you wish the Congress members would ask Jay Powell that was not answered yesterday?
What I always want to know is, because of the historic idiot lack of dissent within the Fed, is what is the makeup he sees as they go to the March 22nd meeting, and what will the debate be over where we are right now? I don't think we know what that debate is.
I want someone to ask, what's the liability of not having a consistent message? What's the liability of possibly increasing rate hikes and then decreasing them and not having some sort of reliability in the market? Maybe it's okay. Maybe they'll say, you know what, this is just the nature of data dependency.
I don't think they will. No, the unanchored is the theme. They want to avoid unanchored, and some of our guests, including in the last hour, Alicia Levine alluding to the 2% is over. We'll have to see. Someone studying that. Let's rip up the script here with Seema Shah, Chief Global Strategist, Principal Global Investors. Seema, to that point, are you working within your beautiful holistic view? Are you working that it is a set of central banks, I should say, that aren't going to get back to what there was? They're not going to get back to sub 2%, 2%, 2.x%, that there's a new level we have to get used to?
So, Heidi, I think that what we're going to see is you're going to see them reach 2% temporarily, even potentially go below 2%, especially if you start to think about hard landings. But if that is to be sustained, you have a very, very different dynamic. So actually, we think that if you're looking at over the next decade or so, we're going to see a world which is very different for the last 10 years. New regime, I know a lot of guests have been talking about this already today. This is a world where you don't have inflation of just below 2%, but it's not very, very high, but certainly no longer below 2% like we've become accustomed to.
Seema, with the turmoil of the last 24 hours, I'm looking now at 109 basis points on the 2-10 spread. Translate that for our audience that are not spread sophisticates. What's it mean for nominal rates forward?
So the key takeaway from this is that the yield curve doesn't necessarily tell you what's going to happen, but it is telling us that investors think that in 10 years' time, or if we're thinking out over a longer term, yields need to be lower, that the Fed is going to have to cut rates in response to something. So the point here is that 100 basis points has only been seen a couple of times through history. When has it been seen? It's seen in 1929, before the Great Depression, in 1973, before another terrible time for financial markets, and then again just before we saw Volcker come in and really take control of the inflation situation. So history is not on our side here. It's telling us that although economic indicators look fairly strong today, there is pain probably coming ahead. So this is a bit of a head fake market rally today. Investors really need to get prepared.
Well, what is fair value then? How do you understand what investors have started to price in the reality that you predict to be the case?
So I don't think investors have fully priced it in. You know, what we've seen over the last 10 years is investors getting very accustomed to low volatility and higher returns. And there is a necessary shift in mind that needs to take place in order to prepare your portfolios, you know, prepare your clients. This isn't going to be a world where you're going to have very, very high returns and low volatility anymore. And in fact, you need to be thinking a little bit more about diversification, thinking more about fixed income quality, and of course, increasing your exposure to alternatives, which could give you that additional pickup that we're unlikely to see in the absence of them.
How much have you increased the weighting of fixed income in your portfolios?
So we have increased our weighting about 4 or 5 months ago, really moving into the higher quality segments. So this is on the short end for treasuries, increasing to investment grade and securitized debt. We have maintained an underweight to high yield. You know, you look at high yield spreads today, they have performed very well this year. But the only times that they've been tighter than they are today is really when the Fed has been dovish or you have an expansionary economy. Two factors that we're not expecting to see going forward. So this is probably as best it's going to get for some segments of the credit market. So it's really important that investors, yes, increase your exposure to fixed income because of diversification benefits, but make sure that you are focused on that high quality segment of the market.
Okay, that's too complicated for me, Seema. Help me out here. Do we flip 60-40 on its head, where it's 40 equity and 60 bonds?
So I don't think it's necessarily flipping it quite like that, but I also wouldn't say 60-40 is the way forward. We're thinking that, look, you have to have a fairly significant portion focused on equities going forward over the long term. Again, same thing for fixed income, but now you need to start introducing the alternatives element into your bucket if you want to have any hope of gaining any kind of reasonable return going forward. So it is rethinking the past a little bit, but we do believe in the diversification benefits of bonds still, despite the terrible performance of them last year.
Seema, in the turmoil here, I need a guide. And you know, I'd make a joke about it, Seema, and say I need a guide for the next 78 minutes. But I just need a guide to get to Monday. okay? We've got to get out in front of key U.S. data as well. What do you do if you're scared stiff to get to Monday?
Because I understand the fear of getting to Monday. You know, we've just heard from a Fed that has said that everything, they are as data dependent as the market is, which means that the non-farm payrolls number on Friday is of the utmost importance. Even if we get through to Monday, we're still got to think about Tuesday with the CPI number. I don't think we've ever been in this situation before. I think it's very, very uncertain. It's not helpful for investors. It's certainly not helpful to the public. I actually believe that there's a bit too much transparency from the Fed and taking a step back from their side, giving us a bit of a slightly longer term view, and certainly as an investor from our side, that really that importance of focusing on the longer term rather than the kind of the week by week dynamics, because they are very, very confusing right now.
And Seema, Alicia Levine agrees with you and says, they're just talking too much. Just stop at this point. It's too much transparency. I am curious about all of the narratives that are getting turned on their heads this year. And I'm thinking about the go long Europe idea that we saw really perpetuated throughout January and even some of last month. Does that change as the Fed potentially becomes much more hawkish than people had expected?
I think you could see a little bit of the drowning out effect coming through for Europe. But there is a slightly different narrative for Europe, which is, I think, is going to carry it further, which is that whereas the US, we think, is really heading for a recession, Europe does feel like the recession is behind them. Their economic weakness is in their past. And from here on, we're not expecting a very, very strong recovery, but it is a fairly solid recovery, which they are then helped along by China's reopening. Some fundamental improvements, focus on ESG, which I think is going to be a really important focus for investors, of course, going forward, and they're miles ahead there. So I think the European story is stronger than what you see for the US. But if I'm going to rank global regions, I'm going to put emerging markets in China above Europe, simply because they have a very, very different economic regime going on there compared to what you're seeing for developed markets.
Seema, thank you so much. Just a terrific brief this morning amid this turmoil. Seema Shah with us this morning from the principal group. 108 basis points on the 2-cent spread. Key item here, as Lisa mentions, green on the screen. Let's move back 90 minutes ago, Lisa, where we talked about, I believe it was with Alicia Levine, I may stand corrected on that, maybe it was Kelsey Barrow, where we talked about bond issuance. So you got a company, and they got talcum powder, they got Band-Aids, they got baby oil. Well, you know what that company is in America immediately. It's Johnson & Johnson. I hate the name Kenvue, Kenvue. You think a McKinsey consultant came up with that?
Well, hold on a second.
What am I going to name it?
So they have a debt offering that they're selling right now. They're selling dollar bonds, and they're selling them in 8 parts, including a 40-year security.
Yeah.
And there are 2 ways to think about this. One is, well, you know, you might as well fund the spin-off and do this now. The second way is, if you want to get in now, because you could potentially even go higher. That's what Kelsey was saying. Yeah. And that to me is really interesting, especially with the second way is, if you want to get in now, because you could potentially even go higher. That's what Kelsey was saying. Yeah. And that to me is really interesting, especially with a 40-year piece. What are these companies hedging against with selling and locking in borrowing costs now?
And Johnson & Johnson, I mean, the 8.1% debt, I mean, at least they're not embarrassing. Let's look at another upstart company that has trouble generating cash. Apple Computer, debt weight, 5.1%. That breaks every single comment I've ever seen in any fixed income textbook.
Let's see when Verizon sells, because they are good at timing the market. That's Apple and Verizon are some of the ones that manage to sell debt at the absolute
me, folks, but I can do this.
And then, you know, usually bond prices go down.
51% debt out at VZ, 51 bank at 52%. What an historic day this has been. Stay with us. This is Bloomberg Surveillance. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Talk about Starbucks for a moment. You've been on the board for how long?
Wow, a long time, since 2006.
Okay, and when you got on the board, did you have to go to Starbucks every day? And
I go to Starbucks a lot.
And
Yes.
when you check in, do you have to wait in line like everybody
Yes,
else?
I wait in line like everyone else. That's an important part of the process to see how everything's working, how long it takes, what's happening in the store. I take pictures of the cases. I do all sorts of things when I go in now.
So what's your favorite drink, can you say? Is that a state secret?
I make a joke about this. So I like my coffee black like me.
Okay. Now, Howard Schultz has been a mentor to you a bit. Is that correct? He's the founder of Starbucks.
Sure, for sure. Very important.
So what did he do that made Starbucks so successful? There are other coffee chains around the world, and it wasn't like he invented coffee chains. What did he actually do that made it the biggest in the world?
He really started off from the very beginning saying that he wanted to create a different kind of company and that he had this point of view about leading through the lens of humanity. It sounds like it could be a cliche, but it's not at all. It is very much in the DNA of the company, how we look at things, how we do things. It's always through this point of view of people. And so at the end of the day, I think he put people first, not only in terms of the partners of the company, but also in terms of the customer. And at the end of the day, that is what has made the company so great.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of pre-work before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
What a 24 hours in this market. Get ready for Chairman Powell, day 2. Live from New York City this morning. Good morning, good morning. Equity futures just about unchanged. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, a second take of Chair Powell on Capitol Hill as investors contemplate the return of jumbo rate hikes, and the ADP report comes in hotter than expected. We begin with a big issue, opening the door to 50.
There's clearly an upside risk to the March move.
We saw those rate hike expectations start to move higher.
50 basis points is very much on the table.
Chair Powell opened the door, but it's up to the data to decide.
It will matter a lot to markets if it is 50 basis points.
It's very important to listen to the second day of testimony.
Thanks to Powell's testimony yesterday, the fears are back fair and square in the market.
We will see if Chair Powell wants to refine the message.
The narrative can completely change if that jobs number on Friday is not in the same universe as it was the last go around.
Does he want to reinforce the message? Does he want to walk back?
It all is predicated on the data.
Joining us now to discuss is JP Morgan's Oksana Aronoff, Crossmark's Victoria Fernandez. To the both of you, thanks for being with us. And let's start with you, Oksana. Just how low is that bar now for a 50 basis point move from the Fed chair?
Good morning, Jonathan. Really interesting yesterday in the course of Powell's testimony, the odds of this hike moving from 25 to 50 basis points jumped from 35% to something like close to 70% or high 60s yesterday. So we'll see what today brings. But certainly a lot rides on the job numbers and the CPI number that's coming next week. And that's going to further tilt the scale towards 50 or back towards 25. I think 50 would be still, kind of a shock to the market. But perhaps it is time for the Fed to shock these markets. The Fed has been, I think, unnecessarily sort of transparent to the point where we're all caught up in parsing Fed speak incessantly. But be that as it may, I don't think at the end of the day, and this has been our view consistently for some time, I don't think that what matters is whether it's going to be an additional 25 basis points today. What ultimately matters is how long will the Fed keep rates elevated? And finally, the conversation is shifting to higher for longer, which has been our view and why we have not been in a rush to jump into these markets, which have proved to be, once again, the right decision this year.
Well, Victoria, I think that's what a lot of people are finding unsettling. It would come down to pace, then it would come down to peak, and then duration at that peak. We thought we'd dealt with pace, it was 25. We thought we'd had a decent idea of where the peak would be, maybe 5 to 5.5%. And then the debate was how long we'd stay there. And now, Victoria, we're talking about pace again. And I think a lot of people are confused about where this is all heading.
Well, if you remember, Jonathan, before the last Fed meeting, you and I were talking, and I said there was a risk. To me, the bigger risk was that we would have a 50 basis point move instead of having a more dovish move from the FOMC. And we didn't get the 50 basis point move then. So the question is now, I think that the market is finally catching up to where we at Crossmark were before that, wondering why we weren't seeing more action than what was actually there. If you recall, at that time, yields were moving down, right? And we were saying something wasn't right. It didn't make sense how the market was reacting. Now we're seeing the market catch up. And I think the Fed is saying, look, we've been telling you this all along. Are you finally going to jump on the train with us and move along? And I think we are. Now, we need expectations to get to around 90% in the futures market for the 50 basis point usually to happen. We're not there yet, but we could be. But we've got plenty of data over the next 2 weeks before we get to that meeting. I also wonder if the Fed is watching, as I think they are, the longer-term inflation expectations. Let's look at what happened to that longer end of the curve yesterday, Jonathan. It actually came down. The 30-year yield came down while everything else was soaring higher. I think that gives the Fed a little bit of room to make a higher move if they so decide, because those are still well anchored. So I think they have the ability to do it. Whether they do or not, I think a lot of that depends on the data we get over the next 2 weeks.
Well, to your point, I should say up front, this whole conversation is at the mercy of what we get on Friday morning in payrolls and next week in a CPI report. Just how low is that bar? Citi's Andrew Hollenhorst has this to say. He's going with 50 at the next meeting from this Federal Reserve. He says the 255,000 jobs and 0.5% month-on-month core CPI print we project in our final forecast are likely enough to provoke the 50 basis point hike. But what if they don't go 50? What if the data comes in below that 255? Mohamed Al-Arian laying out the dilemma that Chair Powell now faces. Either validate the market move and in the process negate in an embarrassing fashion the forward policy guidance provided just a month ago, or stick with that guidance and fall further behind in the battle against inflation. Oksana, two hard decisions. Which one do you pick?
I think if it were me, I think Chairman Powell should pick the more difficult decision, which is stay with the more hawkish policy, because the moment, as you said, they kind of embarrassingly ducktail and move or walk back their comments, you see markets ease financial conditions, which is exactly what they do not want. And so if they don't want that, then they should be really resolute and actually inject some amount of fear in this market, which continues to a large extent until really, perhaps the last couple of weeks, continues to largely disregard what Powell has been trying to communicate consistently, which is, hey, catch up with us. This is where we are. We're fighting inflation. We're resolute. And by the way, the economy continues to be resilient enough to allow us to do that. And the more market participants ease financial conditions, the more resolute we're going to be, because you're making our job that much more difficult. So I think Powell should remain steadfast if he wants to see the results that he says he wants to see, which is, taming inflation. And if he wants to go down as the Volcker character in this chapter, which I think he does.
The secondary testimony starts in 54 minutes. Mike McKee, I think a lot of people feel like one day was enough. Do we really need a second day of this?
Yeah, that's kind of the situation today. I'm not sure what else he could say unless he decided that the market reaction scared him. He wants to take it all back, which I very much doubt. The data we got this morning don't give us any reason to move one way or another at the moment, with the ADP numbers coming in at 242,000. It's not a predictor for the payrolls report. The average miss has been 132,000 over the last 6 months, so I'm not sure it's going to have any effect on the market. markets overall once Jay Powell starts speaking. Jolts might, though. 10 o'clock we get that, the job opening and labor turnover. The Fed has hung its argument for tight labor markets on the fact that we have a lot of Jolts numbers. But Jolts is also going to today be adjusted for seasonal factors and population change. So like the January payrolls report, we may have some statistical anomalies there. Beige book this afternoon is something to keep an eye on, though. Does that support the Fed or bring it back? Here's the problem for the Fed in one chart, basically. We had all of these numbers, the payrolls, the CPI, et cetera, going down, and it looked like the Fed was making progress. Then 1 month, it just jumps up in the month of January. So does that mean revert? That's what the Fed is waiting to find out. Markets don't seem to be wanting to wait for them to get the data. We are, as you guys were just talking about, pricing in now a 70% chance, basically, of the Fed going 50 basis points on March 22nd. If we get different numbers out of payrolls and CPI, I suspect those would change significantly. And here's the question I have, and John, I want to leave you with this chart. And Victoria, you said you're waiting for the markets to catch up. Here's one for you. Take a look at what has happened this month. The first line there, the red line, that was the jobs report. Then we get the CPI numbers, then we get the retail sales numbers, and then we get the day when Loretta Mester and Jim Bullard said, we are supporting 50 basis points, and finally the PCE, and the yield curve just trades sideways. It doesn't widen at all, and then all of a sudden Jay Powell speaks and it drops like a stone when he tells you what you should have already known from those previous events. So I'm not sure what the yield curve is actually telling us right now, or whether Powell's going to move it much more today.
Mike McKee, thank you, sir. 2s10s right now, -108, where we have seen a monster move is on the 2-year piece. The 2-year piece has moved about 100 basis points since the intraday lows of early February. And I think after the data we had for the month of January, looking back February, back to January, a lot of people asking the same question and coming to a similar conclusion. Is this economy much less rate sensitive than we thought it was? And what exactly is sufficiently restrictive at the central bank right now? This is what Matt Lazzetti of Deutsche Bank had to say. This line right here. The market should not be comfortable with the notion that a terminal rate near 550 is sufficient. And I think a lot of people are uncomfortable right now, looking at the data we've seen so far. Oksana, I want to come to you on what this all means for the bond market. You came out up front, you sent me a message in early 2023, and you said this is meant to be the year of fixed income, the year of bonds, and I don't think it is. And Oksana, over the last couple of weeks, based on what I've seen in the core fixed income part of the bond market, sovereign debt, the 2-year piece, you're right. What's going on?
So I think we're seeing essentially, you talked about the economy and whether what Powell is doing is sufficient to slow down the kind of economy we have today. And the kind of economy we have today is very different from the economy of the 70s or early 80s, right, which was very goods and manufacturing oriented, or much more so than we are today. Today, 2/3 of our economy is services, and core services inflation continues to be strong. And that is what we were seeing coming into this year, along with a number of other indicators. But I think that's something we really can't lose sight of. The Fed has a direct knock-on effect on goods and manufacturing and housing, but how do you really have a direct knock-on effect on something like services, where you continue to see inflation, where you continue to see the most profound shortages in terms of employees for the job openings that are there? And so I think that will be a consistent issue. And of course, we're also seeing some goods-related inflation rise its head again, for example, in used cars, et cetera. But that's not to say that there won't be opportunities in bonds this year. We absolutely think that there will be. We are now, as a marketplace, operating at a vol level that has been, for many years, standard for bonds, right? If you look at the MOVE index, which is kind of the VIX's cousin in bond land, where it has been for the past 12 to 16 months, is where we used to live pre-Great Financial Crisis. That was kind of the normal volatility level for bonds. So perhaps with central banks removing their meddling, we're going back there, and that means great opportunities. But it is all about the price. Technicals really matter, and they will also drive fundamentals once they become dramatic enough. And fundamentals will have to adjust, and I can't say this often enough. Personal balance sheets, corporate balance sheets, government balance sheets, all of that has to adjust to the new reality of higher for longer. And that is where the opportunities will come once the marketplace and once the economy really internalizes that. And we're not there yet. We're in the latter innings of the hiking cycle, but we're not yet in the later innings of that acclimation process.
What I hear from you then is that high yield spreads have no business being at 390. Is that a fair assessment of your view?
Absolutely not.
So what are they doing down there?
390. Yeah, 390 is below long-term average. Forget, any recession average. And it has been, as I said, our view has been that the economy will be in the short term more resilient, and that's what we're continuing to see. And so, yes, balance sheets were generally strong coming into this, but no, high yield spreads have no business being down there. And as you see more and more of these kinds of deals that are short-term, high coupon, right, just kind of a Hail Mary last ditch attempt to try and stave off a refinancing. When you see deals that come to market and promise to pay you in kind as opposed to pay you back in money, these are all harbingers of wider spreads, down the road. So stay tuned. There will be great opportunities in credit.
Just not yet, from your perspective. Victoria, from the equity market perspective as well. It's interesting to see the move yesterday in rates and then see the equity market drop lower by 1.6%. Now, Lisa was saying earlier on the program on Bloomberg Surveillance that 1.6% in the grand scheme of things, given what happened in the bond market, not much. High yield spreads yesterday basically unchanged. What do you make of that resilience?
Yeah, I think we have to look at the elements within the market, right? When we say that the market was down 1.6%, but what about the NASDAQ, right? The NASDAQ didn't get near as large of a hit as the rest of the market. We actually were trying to figure this out in our investment committee yesterday afternoon. What are the different parts of the market telling you? So maybe the fact that the NASDAQ was performing a little bit better yesterday is telling you that long end of the curve that we mentioned a little bit earlier, maybe that's saying, okay, some of the market is looking through the journey that the Fed is taking, and they're saying longer term, the Fed's going to do what they say. They're going to tap down inflation. That means longer duration assets actually performed a little bit better yesterday. That's some of those tech names. It's those NASDAQ names. I think you can see the same thing in the bond market. A lot of our clients are concerned and saying, do we need to just go all in 6-month or one-year bills in the market right now and capture that yield? Yes, I think you can do part of that, right, with part of your allocation. But I do think you need to look at some of the longer duration assets in the fixed income market as well. You've got a 10-year at 4%. Is it going to go tremendously higher from there? How much of the rate hikes are already baked in? Maybe we go up to or a little bit over where we were in the fourth quarter of last year. Maybe we get to a 430, 435, somewhere in there. But I don't think we go too much higher. Then you're going to have yields come down. So maybe capture a little bit further out the curve as well. So I think the market is, it's very splintered right now. You've got some of those long duration assets performing a little bit better right now. You've got some of those more cyclical names taking a turn based on what they're seeing from the Fed. But you also have some of those staple names saying, look, the consumer is still pretty strong. We've got a strong labor market going. Maybe from a economic perspective for the economy, it's doing better. So I think you've got different parts of the market reacting differently. That's why you need a more balanced, diversified portfolio right now.
Victoria sticking with us alongside Oksana. Let's get you some movers going into the opening bell about 14 minutes away. Here's Abby.
Hey, John. Well, we do have two upside movers to take a look at. One of them being on an earnings big beat. We have CrowdStrike, the cybersecurity firm. Those shares are up sharply, adding to an 18% year-to-date rally into today. They put up a big beat top and bottom. They saw acceleration across all key metrics, solid enterprise business. The professional services saw a 53% ramp, and they also put up an outlook that suggests 33% growth could be delivered, and some are saying that is conservative. So the stock is really solidly higher. Occidental Petroleum, another stock that's higher. This, of course, as Berkshire Hathaway has added to their position, and they bought another 5.8 million shares recently for a total of 200 million shares, a 22.4% ownership there, John. They now, this stock up more than 600% from the pandemic low, plus the dividend, not so bad at all.
Abby, thank you. Coming up on this program, Chairman Powell facing the heat in D.C.
Putting 2 million people out of work is just part of the cost, and they just have to bear it.
Will working people be better off if we just walk away from our jobs and inflation remains 5-6%?
That conversation next.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
If you could speak directly to the 2 million who you're planning to get fired over the next year, what would you say to them?
Inflation is extremely high, and it's hurting the working people of this country badly.
Putting 2 million people out of work is just part of the cost.
Will working people be better off if we just walk away from our jobs?
When you're slowing the economy, you're trying to put people out of work.
We're trying to restore price stability.
It doesn't do families any good if we stabilize housing prices while mortgage rates continue to skyrocket.
The same people who are having high mortgage costs are also experiencing high costs for all the basic necessities of life.
Chair Powell, you are gambling with people's lives.
A showdown between senators and Fed Chair Powell taking shape on day one. Chair Powell heading back to the Hill for a second round of questioning in front of the House Financial Services Committee, finding himself in a bit of hot water as the central bank suggests higher unemployment is a price worth paying to get inflation back to target. Anne-Marie down in D.C. for more. Hey, AMH.
Hey, John. Well, you could expect a lot of the same that we saw yesterday on the Senate side, today on the House side, a grilling from lawmakers. And really, it was that tense exchange between Senator Elizabeth Warren and Jay Powell that really gets to the heart of the issue, which is that to tame inflation, you have to raise rates, and this could potentially mean job losses. She was using the Fed's own projections that we could see a 4.6% unemployment rate. And you saw Fed Chair Jay Powell fight back and say, well, what about the rest of the working people who we are trying to make sure we get inflation down? This goes to the heart of another issue, Jonathan, which is when you also have progressives like Senator Warren talking about the fact that this kind of inflation is hard for the Fed to bring down because it's things like global issues, like supply chain kinks, Russia's invasion of Ukraine, and also what they also point to a lot, corporate greed.
Anne-Marie, day two coming up. It starts in about 40 minutes' time. Anne-Marie, thanks for that. Final word now with Oksana Aronoff and Victoria Fernandez back with us. Got about 40 seconds each just for a final word on the bond market going into day two of testimony. Oksana, first to you.
I think there is a tremendous amount of investing kind of pinned on this hope right now of rates coming down eventually at the longer end of the curve. And, you know, that you should buy and lock in at 4% on the 10-year. I mean, we had the same recommendation, 3.5% on the 10-year and at 2% on the 10-year last year. But if you think about what we've been through over the past 16 months or so, is that, the hope at the start of last year was that the Fed wasn't going to go beyond 2%. The hope at the start of this year was that the Fed is kind of done. And we're learning over and over again that this Fed is resolute, and they are continuing to essentially, right the wrongs that they are somewhat responsible for. And I think that's what Powell is being pushed on in Congress right now, that, look, these measures are painful, and the Fed has to take some responsibility for the fact that they put them in place. But essentially, I don't think hope is a strategy. I think buying bonds at the longer end of the curve when you are being paid, percent more essentially at the very front end with very little to no risk. I don't know. I'm not on that trade, but I do think there'll be great opportunities this year as the bond markets continue to be volatile.
Victoria?
Yeah, look, I think if I'm Powell, Jonathan, I'm pushing back a little bit on these people and saying, look, we're just trying to get the economy back to a stable place. The Congress is the one that kind of artificially created demand during COVID, and we understand why they did. And companies then had to go hire more workers in order to meet that demand. So they're trying to bring that back to a more normal economy. So Congress played a role in this too, and they need to recognize that. And with that premise, the Fed is going to continue to hike rates in order to make that happen. That means the short end of the curve is going to continue to go higher. It's a good investment opportunity on the short end of the curve. We're going to see the inversion continue as those short ends go higher, but I think you will have some opportunity later this year. I do think we're going to get a recession later this year. You'll see some spreads widen out.
Victoria Fernandez, thank you, and Oksana Aronoff as well. Coming up on this program, the morning calls and later, markets focused on the host of upcoming data and Chairman Powell, day 2.
For parents and anyone out there who still doesn't quite understand, what exactly are kids doing on Roblox?
Kids on Roblox aren't just playing, they're learning, they're hanging out together. When they can't be together in real life, they're hanging out on Roblox. They could be playing hide and go seek. They could be pretending they're running a store or a pizza parlor. They could be making the next big game or adventure. So it's really a wide range of things, and it involves doing things together, pretending you're together.
Everybody is talking about the metaverse as something that's going to happen in the future, but there's an argument to be made that Roblox has already built a metaverse. What do you think?
I think we've started. There's still so much innovation to be done, and there's so much invention to be done in this category that it's mind-boggling.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Equity futures just about unchanged. Let's get you some morning calls. First up, Wedbush raising its Apple price target to 190, reflecting positive demand trends for iPhones out of Asia. Argus upgrading Nordstrom to buy, expecting stronger results after reducing inventory and improving its supply chains. And finally, Berenberg downgrading Tesla to hold, seeing a limited upside after running more than 50% this year. Up next, inflation isn't going anywhere. That's the view from Bridgewater's Karen Carneal-Tambor. That conversation is up next. Your opening bell just around the corner.
So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Seconds away from the opening bell this morning. Good morning to you. Equity futures totally unchanged on the S&P off the back of yesterday's sell-off. The Nasdaq going absolutely nowhere, positive almost 0.1% or so off the back of the carnage in the bond market over the last month or so. A 100 basis point move at the front end of the curve from the intraday lows on a 2-year last month to where we are right now. Let's see opening bell, switch at the board and get to the bond market. Yields look a little something like this. The 10-year yields are lower by 4 basis points, 391.68. On the 2-year piece of this curve, your 2-year through 5% in the last 24 hours. For the first time since 2007, we dropped just below that level. We come in a couple of basis points. Let's call it 4.99 on a 2-year right now. Outside of that, in foreign exchange, euro dollar 105.53. Big day of gains for the US dollar yesterday. The strongest dollar move we've seen going back to November of last year. And just to round things out, crude right now 76.50 on WTI. We're negative 1.3%. One stock to watch at the open is Campbell's, topping earnings estimates and raising its full-year forecast. The company saying this: we've successfully navigated the dynamic economic environment to mitigate inflation using targeted pricing and cost-cutting initiatives as consumers absorbed higher prices. Abby has more. Hey, Abby.
Hey, John. Yeah, it's really impressive maneuvering that they have done out of the pandemic in terms of passing along those rising costs. A can of chicken soup prior to the pandemic, less than $1, now well above $1, more than 30% inflation there, but consumers willing to pay it. So they put up this very strong quarter where they beat both top and bottom line estimates, passing along those higher costs. They've also set themselves up to meet their updated sales growth guidance of sales growth of up 8.5% to 10%. Soup sales up more than 12%. It's interesting, though, their earnings have actually stayed about the same. So this is a piece of that navigation that they're talking about. But relative to sales, their snacks were strong on Goldfish crackers and the Pepperidge Farm cookies. Relative to, again, soup, very strong growth there. And those higher prices and volumes compared to a year ago quarter that was really beset by supply constraints. So over the last year, you can see that Campbell Soup really outperforming the broader consumer staples sector in a big way, roughly 25% outperformance there. Not the same, though, for Brown-Forman, the parent of Jack Daniels. They beat on sales, not so much for earnings, a 55% miss. So you could say that they're having a harder time with rising prices, but it also has to do with currency. That stock is down, not surprisingly, John.
Abby, thanks for that. About 2 minutes into the session then, the equity market's up by a couple of tenths of 1% on the S&P. On the Nasdaq, we're up by a third of 1%. Day 2 of testimony on Capitol Hill, this time in front of the House Financial Services Committee. That begins in about 28 minutes time. for Chairman Powell. The inflation debate continues. This is what Bridgewater's Karen Carniel-Tambor has to say about it, expecting inflation to stick around for a while. Here's the quote. The bottom line is this is not a 2% world. If we want to get back down to 2, that's not going to happen magically. It's going to take either much more economic weakness than we've already seen or significantly more tightening in order to bring it down. Karen, I'm really pleased to say, joins us right now. Karen, fantastic to catch up with you. Can we start there? Because this hope that we go back to the 2s, 2% growth, 2% inflation, maybe 2% on the 10-year, are you saying that hope's misplaced?
Yes, I think it's definitely misplaced. I mean, we came out of this long period where there was kind of a gravitational pull of inflation to 2 or even lower than 2. And that's such a great thing if you're a central banker, because it basically means you never have any tension. You can always ease as much as you'd like because there's nothing on the other side pressuring you not to. And I think we're just out of that world, and Powell is just the first central banker in a long time to experience what it's like to actually have constraints, where you have both inflation goals and growth goals to accomplish, and they're kind of at odds.
Do you think there's a secular component to this that we're still underestimating?
Absolutely. I mean, I think that one of the easiest ways to think about it is think about everything you heard a company spend on the previous 10 years. Almost every time a company spent $1 from 1980 or so, they could pretty much tell you very reliably, I know that that dollar is going to reduce my cost structure. I'm, for example, moving my workers to a cheaper country. So even though I'm spending money, I know that's going to end up causing deflation at the end. Now, what do people need to spend on? Resilience. What does that mean to have another supply chain? Having an extra supply chain means you're spending twice. You're not going to reduce costs through that. You have to spend more to be able to be resilient to all sorts of geopolitical problems. What does decarbonization lead to? I mean, it's very helpful in the long term to avoid climate change, but in the near term, that's spending that's not going to lower your cost base. So we're seeing a lot of spending that needs to happen for defense, resilience, climate change reasons. And then in addition to that, the big wave of secular disinflation, like things like globalization, is basically so behind us in the sense that everything we buy, our iPhones, our this or that, any good, it's already globalized. Going through another cycle like that is what would be needed in order to have disinflation come out the other end. So those are big secular pressures that are going to be with us for 10 years, 20 years, and it's a big reversal from what we've experienced till now.
Well, this is a multi-decade call, and that raises the obvious question on day 2 of Powell's testimony. Is the Fed chair trying to tackle secular issues with the blunt tool of interest rates?
I don't think Powell has any choice. I mean, he's coming out of an environment where, for the first time since more or less coming out of World War II, you had monetary policy and fiscal policy stimulating at the same time. And we saw it's extremely effective because you print money and literally send people checks so they can go spend those checks. Very effective way to get inflation going, and that's what's happening now. And he can't control what the lawmakers in Congress do. That stimulus has already been out there. Everyone got their checks. It's not like there's a lot of that being pulled back proactively. And he's got a very, very, very strong economy. We're seeing the jobs numbers. We're seeing the income numbers. We're seeing the wages numbers. And he can't allow on his watch for inflation to get out of control.
Given the framework you have, though, Karen, how far do you think they're going to have to go to control inflation?
Look, there's no saying exactly how much more they'll have to raise rates because we're in a world where every time they raise rates, it takes time for that to fully flow through the economy, and we just don't know how much of the prior rate rises are still ahead of us. But it sure looks like the economy is resilient, and they're going to have to raise certainly more than is priced in. If you look at the market pricing, it's actually suggesting that they're going to be able to cut pretty soon, and that seems completely implausible to me, and that's what's still in the markets.
Are you closer to 6 then, on the peak rate, on the terminal rate, in this hiking cycle?
Closer, but what's great as an investor is you don't even have to be able to call that because you know that when you're buying, what's priced in is even declines, let alone getting anything like that.
So tell me how big you think the disconnect is right now between this bond market and risk elsewhere. Equities, which are still looking pretty resilient, high yield spreads, which are still south of 400. How big is that disconnect?
I think that the stock market hasn't internalized yet that there's going to have to be an earnings recession that has to come. And if you look at it, right now, earnings are already down somewhat at sort of the S&P level, even though the economy has been extremely resilient, which is rare. Usually you don't get that. So earnings could fall a lot more if you actually get the economy slowing. And eventually the economy will have to slow to get the inflation under control. And so what's basically happened in the stock market is more or less just processing higher rates. Higher rates means that you have a higher discount rate of all those cash flows into the future, but not really processing that a recession needs to be coming at some point.
So in the meantime, you've got equities challenged, against the backdrop, as you say, tough earnings. You've got bonds challenged against, as you say, the issue of inflation, which raises the question, Karen, where on earth do I go for uncorrelated diversification? Because equities and bonds are still rising and falling together. I don't see how that breaks anytime soon based on these developments. Where do you go?
Yeah, that's right. I think it's one of the toughest environments to invest in risky assets that we've seen, certainly in our lifetimes, and probably more than our investing lifetimes, because the job of the Fed, as we've been talking about, is to make cash attractive, is to raise the cash rate and make that attractive and slow the economy that way. And that means that increasingly investors are going to be looking and saying, wait a minute, am I getting enough compensation for sitting in a risky stock, for sitting in a long-term bond, versus what I can get basically risk-free having my money in cash? That pull towards cash is part of what's going to help slow the economy and get inflation further under control. And I think the best diversification that investors can find right now in the markets is, first of all, moving more of their fixed income towards inflation-linked fixed income, where they're actually get paid the inflation as it occurs. That's a possibility most investors haven't really, kind of utilized sufficiently. And number two, looking around the world. Not the whole world looks like this. So look at places where you don't have an inflation problem, like Japan. You don't have a persistent inflation problem there. They're still going to be really excited to see 2% inflation happen, let alone more than that.
When they are screening for uncorrelated returns, they often find themselves in China. Karen, the risks around that story right now, and as you said it in your notes recently, you said this, you said we could face a multi-decade route of spending to extricate ourselves from China. I get that 18 months ago it was uninvestable. Now all of a sudden people are piling in, given the reopening. What are the risks around that story?
I think that Chinese assets still do provide very significant diversification relative to almost any asset you can buy. China is just such a large economic entity that very much goes according to its own drum, if you will, right? They have their own monetary policy, their own fiscal policy, and you see that when they're reopening, that's out of step with the rest of the world. So you're getting true diversification. I think the pricing of the equities is still pretty attractive. You just look at how much do earnings have to really grow and outperform to do well there. They don't have to grow that much relative to what's priced into the US. Very attractive. The bonds are very different, very attractive assets. And so to me, this is definitely a diversification play that investors should be looking at very seriously. And from a secular perspective, it's very clear that there are big opportunities there. That said, I think investors have to consider their risk tolerance and how they look at what will happen geopolitically, what their tolerance is to that. And we don't know where regulation will be going. We don't know what it'll be like to have assets there. And we know that there'll be more screening, more questions. And so it really depends on different investors, their circumstances, and their ability to utilize that diversification given their circumstances.
It's clear from what you're saying, though, suggesting is that we could be facing a leadership change within equity markets, a leadership change between geographies, that maybe that leadership comes from abroad. And it raises the specter of something I know you've addressed already, but I'd love for you to elaborate on just how vulnerable the US dollar might be against the changes of those flows, those cross currents.
Well, I think you get these 10-year, sometimes longer moves where investors pile into one thing, and then you have a vulnerability build up that once it shifts can go pretty far. And right now, the biggest thing that's happened in the last 10, 20 years in the stock markets is that US tech companies kind of ate the world, right? They were the highest performers. They took over every industry. And if you look anywhere around the world, most of what people hold is US stocks. US stocks are a huge part of global market cap. That's where everyone is comfortable investing. And that basically means that it can't go much further than that. They can't go and, again, double their allocation to the US. It can really only stabilize here or reverse, and they'll be interested in other areas. And so many other areas have been sort of ignored. You have almost no investors talking about other stock markets around the world because they're so heavily in the US and in tech. And that is just one thing that adds to the vulnerability of a dollar as that shifts, as you get pricing to be extreme. And the same thing, Fed, most extreme to tighten, strongest economy. As that shifts, you just have a possibility for the dollar it's just positioned at such an extreme. The US needs to be getting inflows, needs to have that all continuing, that when it topples, that has room to run.
So let's make a big bet. And I know maybe right now is not the moment to make big bets, but let's take a multi-decade trade if we can. What would that be for you? I mean, 3 decades ago, get along the bond market, 3-decade-long bond bull market, and you're thinking we upend that. What's the bet right now?
Let me say one thing I think is a fun fact, which is if I told you with certainty through history what will happen in 20 or 30 years, it's actually very hard to make money as an investor that way. The fluctuations along the way, disaster. So it's pretty amazing. You test that. You say, I tell you with perfect certainty in 1980 what happens in 2000. Yeah. Not that helpful. So I'll just say what I'm about to say, probably not that helpful because the time frame is so long. But I think the most clear multi-decade bet in my mind is that inflation is going to matter. And so investors are not going to be able to look at assets and sort of forget their inflation characteristics. And until now, you've just had a multi-decade period where you can ignore inflation and not think about the inflation characteristics of assets at all. The best example of that is that stocks and bonds were highly diversifying because inflation just wasn't a factor. So every time growth fell, you could ease, that's it, high diversification. And I think that world is gone, it's going away. And that means that it's not where assets will move, but what their relationships will be to each other. That has to change with the move we have in inflation.
I won't hold you to that. And Karen, I agree with you. I think a lot of people watching, there's nothing more frustrating than getting the macro call right and then the market call wrong. I did want to finish on this, though. It's International Women's Day. We always go out of our way to showcase the best talent on Wall Street when this day comes about. This could be a world-class lineup any day of the week. I said that already this morning. Karen, when I speak to professional women on Wall Street, though, I think they get frustrated by having a special day, by having quotas. Some of them actually find it quite offensive and just want to be treated as any other person with a fantastic resume, great qualities to contribute to a big business. Karen, in your experience, what do we need to do better on that front?
Yeah, I love having International Women's Day, personally. I think that it was meaningful to me when I was growing up in the business to look up and see women doing different things. And it's meaningful to me today as a mother to do this role as a mother of two and have women who are not yet mothers think through what it would be like to become a mother and that you can do this role as a mother, because it was something I was certainly nervous about before having children. What would that be like? I think the mother's role is special and unique, and the fact that there haven't been as many women on Wall Street through time means that our role is important, and it is important to showcase that and realize that there are women in all these positions in Wall Street and in the investment industry that do this, and it doesn't, like you're saying, in some point, it will not matter what gender you are, but at this point, I still think there are people looking to us to know that it's possible.
Well, Karen, I can say you're a kick-ass mom and a whole lot more. Thanks for being with us today. We appreciate it. Karen there, Taryn Bohr on the latest from Bridgewater. Karen Bohr, just absolutely fantastic. Up next on this program, the bill to ban TikTok, getting Biden's bid.
We're working with Congress to address concerns posed by apps like TikTok. This is not about a political concern. This is about making sure that we do the right thing for the American people.
That conversation up next.
Balance of Power is on the move. Starting Monday, March 13th, Balance of Power debuts at 5 p.m. Eastern Time, live from Bloomberg's Washington headquarters. Hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis at the intersection of politics and business. Balance of Power, weekdays at 5 p.m. Eastern, starting Monday. Only on Bloomberg, your global business authority.
My grandfather got into the mutual fund business because the average investor could not get a diversified stock portfolio, and it was too dangerous to put, your entire savings in it, just a couple of companies. So the mutual fund was created to give a diversified expert management at a reasonable price. Today, we have a phenomenon where companies are waiting much longer to go public. And so in 2000, the average company went public after 3 years. Now, companies are waiting 9 to 10 years because there's so much money available in the private markets. As a matter of fact, there are half the number of public companies that there were in 2000, and there's 5 times the number of private equity-backed companies. So just from an investable universe, you look at the private markets, and it's significantly bigger. So the question is, that return that used to be captured in the public markets is now captured in the private markets. But the problem, as you know, is you're really tied up for a long time when you invest in a private equity fund. And so trying to figure out a way to solve the same problem my grandfather was trying to solve, which is how do you bring those returns responsibly, the democratization of the private markets to the retail investors. And I describe it as a bit of like running with scissors. Scissors is a great tool if you use it appropriately. And so we're focused on trying to figure out responsibly bringing it in to the average investor.
Everybody's talking about TikTok.
There are a lot of us that are concerned about privacy.
The risks of insecure information and communication technologies.
We need Congress to move beyond the whack-a-mole solution that we have been focused on.
Our tools to date have been relatively limited.
We have to make sure that we have the resources in place and the authorities in place
to establish a holistic and methodical approach,
a more strategic approach,
a more comprehensive approach.
I do think we're going to pass this.
The White House endorsing a bipartisan bill giving the president authority to ban or force the sale of TikTok. The National Security Advisor Jake Sullivan saying the following: "We look forward to continue working with both Democrats and Republicans on this bill and urge Congress to act quickly to send it to the president's desk." TikTok pushing back, a spokesperson saying the following: "The swiftest way to address any national security concerns is for the Committee on Foreign Investment in the U.S. to adopt the proposed agreement that we worked with them for nearly 2 years on." Anne-Marie joins us now down in Washington. Hey, Anne-Marie.
Hey, John, it's not a TikTok bill in name. It's called the Restrict Act, but certainly it's going after an app like TikTok. And what this bill is trying to do is give the Commerce Department a lot more tools, actually an extension of what we saw under the Trump administration, an executive order, to go through a process to see what kind of foreign technology potentially could be a national security risk. And Secretary Raimondo actually said she thinks it's bad policy to go after a specific company, but there should be a process. And this bipartisan bill, you have a number of individuals from both sides of the aisle signing up for it. But key is that it does look like it's one of those TikTok bills that the White House is also willing to sign off on.
AMH down in Washington. We will see. Terry Haynes of Pangea says he reckons they're going to do it. The recent push to ban TikTok paying dividends for a number of US-listed stocks, as you can imagine. Shares have snapped lower this morning, but this coming after 3 days of gains, jumping more than 10% since Friday. CFRA weighing in on the possible market implications, saying the following: a potential ban would likely improve engagement for US social media outlets and drive greater ad dollars to those platforms. He goes on to say, "We believe the biggest beneficiaries of a TikTok ban would be Snap, Meta, and Google's YouTube business in that order." Ed has more. Hey, Ed.
Yeah, good morning, Jonathan. You're right. Snap down more than 4.5%, biggest drop in more than 2 weeks, snapping 3 straight days of gains. And it was only 2 days ago that we closed on Snap above the 200-day moving average for the first time since October 2021. The logic's really simple. If the United States were to ban TikTok, there are 1 million eyeballs that would go elsewhere. And as you said, a number of sell-side names point to the read-through benefit and potential upside for names like Meta that have focused on ephemeral video and short-form video, but also YouTube and Snap, crucially, because of the similarities between the two platforms. This is a really interesting one for the ARBs, because actually, if you look at the reaction this morning, having had a night to digest the contents of this proposed bill, even though there's White House support, TD Cowen, for example, points out there's no presumptive requirement to divest TikTok. That is different to previous legislative attempts in this area. Many of the previous drafted legislations have asked for some sort of divestiture. That's not the case here, and so actually there is a sense, a growing sense, including from Bloomberg Intelligence, that the likelihood of an outright ban in this country is unlikely.
Ed, thanks for that. This conversation's going to continue. They have the tools potentially to deal with it further down the road. Whether they choose to execute is another question entirely. Here's the market for you, about 22 minutes in. Let's get you some sector price action. Here's Abby.
Well, John, it's interesting because we have the S&P 500 barely doing anything, up very, very slightly on anemic volume. Once again, relative to the sector action, we have energy in the top spot, up about 0.7%, even as oil declines. That, of course, has to do with Occidental and Berkshire Hathaway taking a larger stake in that company. Real estate, tech, materials are also among the up sectors. Consumer discretionary is the downside sector, down about 0.7%. And then we also, if we take a look at what's happening over the last week or so, we will see that, interestingly, and one of your guests earlier, I think Oksana or Victoria Fernandez actually was making the point that despite the fact that we have yields kind of over the last couple of days, higher over the last week, that 10-year yield coming in, not matching the 2-year yield, that's actually surprisingly giving tech a boost. That tech index over the last week, John, up 3%. I would not have expected that at all.
It's hard to get your head around that, isn't it, Abby? And that's the difficult part of all of this. Karen was speaking just 20 minutes ago, and she was talking about how difficult it is to get the macro call right and then the market call right at the same time. Well, I can tell you, year to date, if you'd guessed what 2-year yields would have done, would you have guessed where the equity market has been? Probably not. This morning, at least, we're down another couple of basis points on a 2-year, just south of 5% after climbing through that level for the first time since 2007 in yesterday's session off the back of day 1 of Chair Powell testimony. Day 2, just around the corner, your 10-year comes in 5 basis points, 3.92, a couple of days away from a payrolls report. Up next, your trading diary.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Minutes into the session, call it 26. Equities just about unchanged going into day 2 of testimony on Capitol Hill from Chairman Powell. That's the price action. Let's get to that trading diary. Top of the hour, Fed Chair Jay Powell kicking off that second day of congressional testimony. Full coverage, of course, here on Bloomberg. Plus, we get the monthly jobs report ahead of the Fed's beige book. That's the JOLTS report, the monthly JOLTS report just around the corner. President Biden releasing his budget proposal tomorrow. Look out for that. Governor Kuroda's last BOJ rate decision coming up on Friday. And finally, the main event, payrolls to close out the week. Looking forward to that. From New York, thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
News breaks. No one covers the world like Bloomberg.
6 people have died from these latest quakes, adding to the 41,000 plus people who've died in those major quakes 2 weeks ago.
A top Sam Bankman-Fried associate said to be nearing a plea deal.
How does that help build the case for the prosecutors against Sam Bankman-Fried?
Biden is here to say we will stay with Ukraine until the very end, and that's really a show of support as well for the allies.
Bloomberg, your global business authority.
DOJ or other authorities
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
Is it the OK's getting ready to make?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Weinergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there, like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is, when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small and, well, space is really big. And then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation was exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I am about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwit, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that They're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
Usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.3 2.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, a language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
refer to the dictionary also, okay, and find out the new meanings. As well as described about. Hey, Ruchita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very